Hello, everyone. Thanks for joining today's event, Keeping the Power On, Financing Energy Storage Solutions. We'll get started here in just a few moments. Looks like we have several people joining in. All right. Well, welcome everybody. We're very happy to have you today for today's event, Keeping the Power On, Financing Energy Storage Solutions. My name is Tom Byerly. I'm with Ross Strategic. We're supporting the Global Energy Storage Program for today's event. I'm really looking forward to engaging with an interesting set of speakers on the topic of energy storage. This meeting is hosted by the Climate Investment Funds, and it's the third in a series of events in 2021 on the transformational potential of energy storage. And today's focus will be on energy storage finance, looking at that from a variety of perspectives and drawing on a lot of experience from work around the globe. Before we get started, I'd like to turn it over to my colleague, Melissa Banales, just to talk a little bit about participation in the meeting today and effective use of Zoom. Melissa?
Thank you, Tom. Hi, everybody. As Tom mentioned, my name is Melissa Banales, and I just wanted to go over a few technical reminders. The first one is that the meeting is being recorded and will be available on the website in a couple of weeks. We ask that you please mute yourself if you are not speaking. We want to avoid that background noise. There is an option for live captioning in your toolbar that should be enabled. And then we ask that if you have any questions that you raise your virtual hand, and that can be found either in two ways, in your Zoom toolbar or in your participants list, depending on the Zoom version that you may have. And if you have any technical questions or have any questions in general about technology, not tech energy, but feel free to chat me and I will be able to help you if you need any technical assistance. And with that, I will hand it over to Danny Morris.
Thanks, Melissa. Hi, everyone. Good morning, good afternoon, good evening, whatever part of the day it is for you. I hope it's a good one. Welcome and thank you for joining us. As Tom said, this is the third event in the Global Energy Storage Learning Platform. We have been undertaking the platform over the course of 2021 in support of the Global Energy Storage Program. Let me start off by introducing it a little bit and us a little bit. I'm Danny Morris. I am the Clean Energy Lead for the Climate Investment Funds. And since I've been on a little under 2 years with the CIF, we have been working to stand up this program. Which is a new approach for us in the CIF, a little different than what we've done previously. Happy to tell you all about it for those who don't know, but I guess let me start off by talking a little bit about the wider context in which we're meeting today. So December 2021, we are in the afterglow, if one can call it that, of COP26. And COP26 was interesting because it was sort of the first time internationally the discussion to the energy transition really was front and center. And as different countries in the world really looks to transition to a decarbonized future, we have to think about what that means. And if we're going to meet the Paris Agreement and our other climate goals, that means we really need to support higher penetration of renewable energy, which needs to be supported by major increases in the capacity of energy storage. According to ARENA, approximately 325 gigawatts of pumped hydro storage and 150 gigawatts of battery storage would be needed globally to help grow the renewable share of renewable energy to 45% by 2030, which according to their calculations gets us on the path to zero carbon. If you look at the IEA, they estimate that solar and wind power need to increase 4 times current levels within the next decade. And even more would be needed to reach a target of 60% renewables by 2050. So there's a big task in front of us, and I think those online with us here understand the role that energy storage can play. But what we're seeing currently is that developing countries really account for a very small share of the energy storage market. If you look at batteries alone, Australia, China, Korea, UK, and US account for 80% of new battery storage systems since over the past couple of years. Projects in developing countries account for less than 20% of the market, which means there are hopefully a lot of opportunities, and there's a long way to go to get where we need to. That's where we hopefully come in to help. We are the Climate Investment Fund. For those who don't know us, we are at this point an $11 billion fund focused on driving climate action through more than 300 programs in 72 developing countries. Our business model is simple but effective. We work in partnership with 6 multilateral development banks to provide large amounts of concessional finance that's risk-bearing, patient, and at below market rates to support projects across the climate action space. That includes clean energy, energy access, sustainable transport, resilience, and forestry. Our business model, for those who do know us, is best known for what's called a programmatic approach, where we ask countries to put together an investment plan to be executed over a period of time with sort of a set resource envelope. But the Global Energy Storage Program is the first time that we've really focused on a specific thematic area to help facilitate investment in that space. Our hope is that we can bring the power of our concessional resources to help kickstart storage investments in a number of emerging markets. So the program itself has about $345 million worth of resources, and we're looking to use that to build on an existing portfolio of $400 million that's been deployed over the past few years. Rather than focusing on one type of storage, the program is technology agnostic and really aims to support policy interventions, technical assistance, knowledge coordination, along with direct project investment to help, as it were, 1,000 flowers bloom as much as possible. So far, our program, since its launch this time last year, actually, we launched in December 2020, we've approved more than $107 million in financing for 8 projects. Those 8 projects, many of which are in Latin America, in countries like Haiti and Brazil, but also Bangladesh, Ukraine, and South Africa, are expected to attract $1.6 billion in co-financing, a third of which can come from the private sector. So we really are looking to continue our pattern over time of engaging private sector and bringing them into this space, as well as the engagement with the MDBs and governments. That 1.6 billion is actually more than half of what we anticipated for the entire program when it launched. So I think that bodes well for the impact that we're expecting, because we have an additional 18 projects in the program pipeline. So there's a lot to look forward to within the program, but to complement the growing portfolio of operations, we spent the past year developing and hosting this interactive learning platform to support dialogue and knowledge exchange amongst groups of stakeholders that maybe don't interact regularly. So in addition to the partnership that we already have with our MDB partners, we wanted to build connections with stakeholders that have different perspectives, from technical experts, people in the private sector, local and national government officials and institutions, utilities, civil society organizations, to help cultivate a community of practice that can really push the frontiers of energy storage investment as far as we can. So our 2 previous events, we hope, have helped build those connections. Our first event, which took place back in May, there we presented the Global Energy Storage Program to the world and sort of took a snapshot of where we thought energy storage was at the time in developing countries. We used that to mine the rich expertise and perspectives of our audience to figure out what are the important questions and what do people want to know. So with that in mind, our second event in July built on those questions and topics that came up. to focus on different types of technology, how they work, what role they can play in energy systems, and how to build a business case for storage in emerging markets and developing countries. Today, we are covering the next key component of deploying storage, which is finance. In our first event, one of the questions that was most frequently asked was about the bankability of storage projects. So with that in mind, and building on the content that we had, we've brought in a number of experts to help us grapple with that question, because they work on it daily and they're going to share their views and experiences with us. So with that, I want to thank you all for joining us, and I'll turn it back over to Tom to launch our first panel. Take it away, Tom.
Great, thank you, Danny. All right, maybe we could go to the next slide. Yeah, I just wanted to say a couple things about today's event before we get started, and talk a little bit about audience interactivity. For the agenda today, we're going to be starting out with the big picture, and really thinking as we come out of the COP26 meeting and are thinking about energy system decarbonization. What does that trajectory look like, and what's the role for energy storage in that? And we have speakers from the U.S. Department of Energy and the World Bank that can help kind of set the stage for the discussions today, and we'll move into that in a little bit. Following that, we'll have the first of our two panels, and the first panel is focused on energy storage, financing, opportunities, and barriers. And in that panel, through presentations and discussions, we'll really start talking about, what's unique about energy storage financing, what are different roles that organizations can play in the energy financing or the life cycle of a financing deal, and be able to hear from folks that are actively involved in various aspects of that energy financing cycle. After that panel, we'll take a little break, and when we come back from the break, we'll be talking about private capital mobilization for energy storage and clean energy, and really hearing about lessons from experience from practitioners that are working all over the globe on various aspects of clean energy and energy storage, and be able to talk to them about lessons from the field, if you will, and as well building on the earlier panel, talking about different roles in the financing process. And then we'll wrap up around 11:30 or so US Eastern time. I do want to remind folks that we are on social media for this event, and we've got the hashtag keeping the power on, financing energy storage solutions, and we encourage people to share information from today's meeting on social media, and we'll go ahead and put that hashtag in the chat and remind folks about it over the course of the event today. Let's see, next slide, please. So for questions and answers and some polling today that we're going to be doing, we'll be using the platform of Slido. This is a audience interactive platform that you can access either on your browser from your computer or on your phone. And we'll be using it in two ways. One is using it for questions and answers when we get into the panels. If there are questions you would like to ask of the panelists, we'll be able to use Slido for that. If you see a question that you find particularly compelling that someone else has asked, you can upvote that, and it kind of puts it to the top of the queue. We'll also be using Slido for some polling and hearing more about you all and your experience with financing. So if at this point people could go either on your phone or on your browser to slido.com, we're going to just do a little test of the system and get people oriented to Slido. So if you go to slido.com, the first thing that you will see is a place to enter the meeting code. And the meeting code for this meeting is 260111. When you enter that, you'll be able to see this meeting and see the polls and the Q&A that are specific to us, and we've put the Slido web address and the meeting code in into the chat. So let's go ahead and just give Slido a little test run here with our first poll, which should be popping up on your screen or on your phone if you're in Slido. And the question for you all to enter is, what city are you joining from? We want to see who we have from around the world here today. So I'll give people a few moments to enter that information. All right, I'll give people just a couple more moments to enter the city you're joining from. All righty, great. Well, it looks like we have a strong showing from Washington, D.C., and also London, Nairobi, Harare, Pune, India, and points around the globe. So this is great. We're truly a global meeting today. All right. Maybe we can go to the next slide and just test out another function of Slido. So the other way that we can use Slido is for Q&A, and that once we went out of the poll, that should have popped up on people's screens. And so we want to just test out the Q&A function with Slido today with a very general question for folks about what questions do you have about energy storage finance, and we'll use these to inform some of the discussions that we're having later today. So let me give folks a few moments just to try the Q&A function of Slido and answer the question about what questions you have about energy storage finance. Great, I'm seeing several questions coming in. This is great. One of the key features of Slido is that if you see a question that somebody else has asked and you have the same question, you can go on the right-hand side, you can like that question, and that helps bring it up to the top of the queue. So this is great. It's really helpful to have these questions at this point. And as we get into the panels, we'll also be asking for additional questions, and we'll give a reminder about that and remind people about Slido and the meeting code as we go through. Great. So thank you everybody for helping us test out Slido. It looks like it is working. If anybody has any questions about how to use it, please go ahead and chat my colleague Melissa Banales behind the scenes in Zoom, and we can address any technical issues folks might be having. All right, maybe we could go to our next slide. All righty, so we're going to head into our first set of presentations today, and this is really about setting the stage for the meeting and the role of energy storage. We have two speakers for our opening session here. We have Alejandro Moreno, Deputy Assistant Secretary for Renewable Power at the U.S. Department of Energy, and Hussein, the Practice Manager for Energy and Extractives for the Middle East and North Africa region at the World Bank. And in these opening sessions, we'll be talking about outcomes from COP26 relevant to investments in energy transition, talk a bit about the role of energy storage in decarbonizing the energy sector, and the role and magnitude of public and private sector investment that will be needed for the kinds of energy transitions that we are looking to accomplish. So I'll turn first to Alejandro Moreno. Alejandro is the Deputy Assistant Secretary for Renewable Power at the U.S. Department of Energy. He directs the renewable energy applied research, development, and demonstration activities for the geothermal, solar energy, wind, and water power technologies office. In addition, Alejandro oversees energy system integration efforts at U.S. Department of Energy. So Alejandro, I'll go ahead and turn it over to you.
Great, thanks, Tom. Thanks for having me here, and thanks to everybody for being here. It's an exciting time to be talking about renewables, and thus an exciting time to be talking about storage as well. As Tom said, I'm the Deputy Assistant Secretary for Renewables at the U.S. Department of Energy. I will talk from a U.S. perspective, but I'm also I lead the Renewable Energy Working Party within the IEA, and the storyline, the challenges and the value proposition of storage are really the same most everywhere. Of course, there are regional differences, there are country by country differences, but the big themes that I will talk about today are as relevant in every one of those cities that just appeared on our screen. So for those that don't know, the US does have a fairly clear, ambitious, but achievable decarbonization goal right now of fully decarbonizing the power sector by 2035 and fully decarbonizing the energy sector by 2050. That is very similar to the IEA's net zero energy goals that came out earlier this year in May as well. What we know is that achieving that level of decarbonization truly entails a transformation of the energy supply, of the infrastructure that supplies and hopefully also stores our electricity and our broader energy. We know that this will entail the modeling that we do internally in the US alone, somewhere around 1 terawatt of solar. Recent National Renewable Energy Lab analysis showed about 1 terawatt of solar by 2035, similar amounts of wind as well, which really imply increasing in the US annual deployments 3 to 4 times above what you see today. Again, similar in the rest of the world, similar growth trajectories required. What's really important to recognize is that doesn't just entail substantially replacing fossil fuel generation or the power system as well, but growing as well to meet increasing electrification or increasing demand due to electrification of other sectors, predominantly industry and heating and transportation. And that means both that we need to grow generation and capacity significantly more than we otherwise would have between now and 2035, but it also means that rate of adoption needs to continue to grow just as steeply between 2035 and 2050 in the electric sector. It also means that there's likely to be pretty significant changes in demand profile. In the US, for example, right now our demand peaks tend to be summer evenings, summer afternoons and evenings driven by air conditioning. It's very likely, our modeling shows, that as more and more heating gets electrified in particular, that the overall annual peaks are likely to shift to winter mornings, driven more by heating than air conditioning. And that has a huge role as well for generation and the ability of different variable resources to provide capacity, and thus the role of storage as well. I will say the big uncertainties around demand profile as well, particularly when you start to factor in electrification of transportation. Depending on the flexibility that we see in the charging infrastructure, the sequencing of different types of transportation, light duty trucks, heavy duty trucks, residential or passenger vehicles, those can all have a really big impact on what that diurnal load profile looks like, and thus the capacity value of different renewables, and again, the value of storage in augmenting that capacity value. So the result, if you take a step back, is we know storage is going to be particularly valuable. In some of these same studies that we look at renewables expansion, almost all of them show just as large expansions of storage, particularly considering the baseline we start from, much larger, hundreds of gigawatts deployed by 2035, again, just in the US, and potentially double that looking at 2050, depending on the assumptions, again, that you use. But the flip side is that you have less predictability, of course, about how it's going to be used. I will say two other things. There are big uncertainties about development also relate to transmission. Certainly, the more transmission you're able to build, the less the need for storage. There's a fairly direct trade-off there. We have big uncertainties about how much transmission we can actually build, particularly given some of the public acceptance barriers, although I think we view building out transmission as absolutely essential to a least cost clean electricity future. And also recognizing that there's the potential for real resilience benefits for storage as well. And this is one of the areas that we're investigating really closely, but looking at what value propositions do you get in terms of withstanding new events, whether they're climate events or cybersecurity events, by having certain amount of storage on the system, certain amount of distributed generation on the system, and different combinations of those. Being able to quantify and put a dollar value on that resilience is tough, and it's one of the things that we think does hold back investment in resilience benefits. But part of what we are looking at DOE right now, making those calculations a bit more straightforward and easier. So on the one hand, you have these very clear value proposition for storage, and you have models that are just based on least cost deployment that show a lot of deployment. On the other hand, you have some pretty significant barriers that a lot of them relating to financing ultimately, that may well prevent that development from occurring unless we as a global energy community think through how to address them. Some of them are technology related, recognizing that right now we don't have really easily available commercial technologies beyond pumped storage hydropower for more than 4 hours of duration, but there are a lot of technologies coming to commercialization, being tested, a lot of these the Department of Energy works on. But we also, at the same time, we recognize that we don't have great ways right now in many of the liberalized markets to provide guaranteed resources for technologies that may not be generating very often, that are primarily capacity and availability resources. There are a number of regulatory challenges specific to storage around its participation, both as a generation asset and as a transmission asset. Who owns it, who's responsible for dispatch, who's responsible for state of charge, and how do you optimize both of those functions at the same time to maximize revenue? And maybe most crucially, what I was alluding to before, you have this really big value proposition, but you don't necessarily have the predictability of your dispatch patterns and your revenue stream that projects in the power sector are used to. And obviously this is because you're building storage under the presumption that you're going to have more and more variable renewables on the system, but the specific nature of variable renewables is you don't know exactly when they'll generate. You can aggregate across it. But we're also looking at a power system that looks very different from that of the past. And particularly when we're looking at traditional project finance, it's very well suited to incremental additions to a system that's extremely well understood. And the results of that incremental addition can be very predictable. But when we're talking about a fairly substantial transformation of the system as a whole, being able to predict the revenues of any one component of that, each of which is necessary, becomes less straightforward. And it becomes a very, very good, important role for concessional finance for many of the organizations we'll hear from today and that are involved in the CIF, as well as for the Department of Energy and organizations like ours when we have funds for that, like in our loan programs office. Lastly, I'd say that in order for any of that to work, there are a couple of things we absolutely need from the storage industry itself. The first is codes and standards and around safety and ensuring enough data to ensure that the technologies are fully safe in any different condition. And secondly, data around performance under different conditions. Every chemistry, particularly around batteries, performs differently under different environmental conditions and has different degradation rates depending on how it's used. We've seen that a lot, for example, for lithium ion that was developed for vehicles being used for frequency regulation. Very, very different discharge pattern, almost polar opposite, and looking at what that means for the life cycle of those particular systems. This is one area where organizations like ours, organizations like the World Bank can help by providing test beds, standardized testing protocol, and even in our case, looking at using artificial intelligence to effectively extend the applicability of certain test periods where we can take effectively 1 year of data, 2 years of data, and extrapolate out 10, 15 years of data for that. Which we're going to need because we don't have time to get 15 years of data from a given test in order to meet our 2035 goals. And so, the department is working on all of those. We are a research organization, differently from a lot of our sort of fellow energy ministries around the world. but looking at new tools to value the role of storage, to predict its dispatch and the economic value to the power system, tools for regulators to be able to understand the implications of that, what types of systems and what kind of costs they can allocate to ratepayers. Again, testing facilities, again, data facilities, data processing, data analysis. But I will say, as we now in the department, we have, in the recent bipartisan infrastructure law that was passed, we have Department of Energy has about $60 billion, including about $20 billion for energy efficiency and renewable energy. Most of these are grants, not loans. Working with the investment community as we develop these products for storage, the storage industry to effectively be able to catalyze investment. Working with the investment community to make sure that we are collecting the right data and that we are validating it in a way that works and that is likely to catalyze future investment. That's a huge need of ours. And so for anybody who's on the line today and is interested in talking to us and working with us, we'd love to hear from you and reach out. We do have about $550 million worth of storage demonstration projects that we were directed by Congress to fund and are working through what those would look like now. And certainly doing so with an ear to the investment community is critical. So again, the big picture message here, if we're serious about decarbonizing the power sector and the energy sector, storage has to play a role. But the current project finance approach and treating storage purely as a generation asset isn't necessarily going to get us there. We need to think differently. We need to think transformationally about the system. That is a critical role for public finance to do, concessional finance. So very glad to see that this workshop is taking place, that there's an entire section on finance today, and really interested to hear what comes of it. So again, thanks for having me, and good luck with the rest of the day.
Thank you very much, Alejandro. Much appreciated. And it looks like there are a couple questions in chat about slides. And for our opening speakers here, we do not have slides for those presentations. We will have some slides for presentations later in the meeting. I'd like to move now to Hussein Beides. Hussein is the practice manager for energy and extractives for the Middle East and North Africa region at the World Bank. He's been working at the bank for about 18 years in Southeast Europe, Central Asia, as well as the Middle East and North Africa. And Hussein's past work programs have included a range of investment, lending, and development policy operations and wide areas of policy dialogue and technical assistance for energy sector reforms, renewable energy development, energy transition and decarbonization, and regional energy integration and market development. So Hussein, we're very happy to have you with us today, and I will turn it over to you.
Thank you very much. Can you hear me, Tom?
Yes, we can.
Thank you very much, Tom, for the introduction, and thank you very much for inviting me to share a few remarks in this event today on financing energy storage solutions. Today, I'd like to highlight in my remarks 3 points. The first one, a little bit on the outcome of COP26, in particular in relation to climate financing. Second, I'd like to review a little bit what have been announced during COP26 in relation to energy storage. And the third point I'd like to talk about is the role of energy storage in decarbonization of the energy sector and what the World Bank and the CIF are doing to support countries developing energy storage solutions. If I may go back a little bit more in time, like about 10 years ago or more, to COP15 in 2009. At that time, it was recognized that climate financing to support large investment in mitigation and adaptations action is essential to meet climate change goals. And at that time, developed countries committed themselves to jointly mobilize $100 billion a year by 2020 to support climate action in developing countries. Back a month ago in Glasgow COP26 Pact, it was, however, noted that these financing targets were not met by 2020. And the pact emphasized the needs for countries to fulfill these goals and mobilize make best effort to mobilize the 100 billion climate financing to developing countries. This financing is very important. If we look, for example, at the adaptation cost in developing countries, that could range could be in the range of 140 billion to $300 billion by a year by 2030. and up to $500 billion by 2050, according to UNEP. Now, despite some concerns on climate financing, there were also positive outcomes in COP26. Mainly, this marked the first time it was explicitly referenced in COP Pact the need to phase down coal and phase out fossil fuel subsidies, which are very important toward achieving the net zero carbon targets. On the energy storage and on the side of the COP26, there have been certain activities where public organizations and private companies came together to launch energy storage initiatives. I like to give example of few. IRENA and United Arab Emirates launched a platform to raise $1 billion for renewable energy and storage. AES and the government of Chile announced the launching of a 5-hour duration battery energy storage project with an investment of around $400 million US. And also on the side of the COP26, the establishment of the Long Duration Energy Storage Council was also launched to support LDS technologies necessary for decarbonization of the grid and to ensure required funding is available for such technologies. This is very important, noting also over the past 5 years, up to $3 billion was invested in long duration energy storage technology. And a total of 1 terawatt-hour of storage capacity will need to be developed by 2025, which requires about $50 billion to be invested by then. Estimates by the Council also indicate that between $1.5 to $3 trillion investment is required to ensure the world has enough storage capacity to support energy transition. Now, this large-scale investment in energy storage shows there is a clear need to develop a new market for batteries and other energy storage solutions that are suitable for electricity grids, including a variety of grid and off-grid applications. Such application will be needed to provide much needed flexibility in the system to support large-scale renewable energy integration required as part of the transition to net zero carbon energy systems. This need also for energy storage, is also evident in the World Bank Energy Program, where we have hybrid energy storage projects in FC countries such as Central African Republic, projects in small island nations such as the Pacific Islands and the Maldives, and also standalone projects in Ukraine for frequency regulation. Up to date in the World Bank, we have about 7.1 of gigawatt hour of battery storage projects identified, of which 4.7 gigawatt hour of energy storage commitments in active projects, and about 2.4 gigawatt identified capacity in future pipeline. The concessional financing support, and thanks to CIF and the Global Energy Storage Program that is organizing this event, has been critical in developing the first wave of battery storage investments. I give you an example here. In fiscal year 21, we had in the World Bank 7 battery storage projects approved by the World Bank, where CIF financing played a key role in designing the projects and providing concessional financing in countries such as Maldives, Zanzibar, Burkina Faso, and Ukraine. CIF is further scaling up the support towards energy storage, where we have an initial $500 million commitment for the newly announced renewable energy integration project to support projects for renewable energy integration, which include energy storage projects. I'd like to end here my remarks, given that the 2 sessions in this event will present more on energy storage financing opportunities and private capital mobilization. But before I end, I'd like to go back to COP26 and say this year, COP27 will be in my region, in MENA region. And I hope we'll come back, we'll go to Sharm el-Sheikh in Egypt, where we have the commitment for the $100 billion of climate financing to developed countries are met by that time. Thank you very much again for inviting me. And I need to apologize because I have to disconnect also in 5 minutes from this event, but I wish you all the best for this workshop. Thank you very much.
Great. Thank you, Hussein, so much for joining us. All right, so we'd like to move now into our first panel, and the panel is focused on energy storage, financing, opportunities, and barriers. And in just a moment, I'll turn it over to Daniel Morris with the Climate Investment Funds to introduce the panel. But before we do that, we did want to do a quick poll using Slido. And this poll is really to get a sense of the roles and experience of those who are on this event today. So the question is, what roles in the financing cycle are closest to your role or experience? So debt lender, equity sponsor, originator or developer, off-taker, or other. So I'll give folks a moment to enter in the poll. If there are people on the line who are wondering, well, what are these roles, and what does this mean? That's some of what we'll be getting into in the panel to come. Great. I'll give folks just a few more moments to enter your responses if you haven't done so already. Alrighty, great. So it looks like we have a strong showing from debt lenders and folks who consider themselves to be other than some of these categories, followed by originator or developer, and then equity sponsor and off-taker. So as we're in the panel and folks are in these various roles or other roles, I would encourage you all once again to use Slido to ask any questions of our panelists. Following some opening presentations and panel discussion, we'll have time to be able to address some of the questions from you all. So with that, I'd like to turn it over to Danny Morris with the Climate Investment Funds to introduce the panel and our panelists.
Yeah, thanks, Tom. And thanks everyone for participating in the poll. I guess I'm not totally surprised to see a large amount of debt lenders on the call, but it was good to see many others. And I encourage people to participate through the chat and submitting questions on Slido to our conversation to make sure that all perspectives are represented. Let me set the stage for this panel a little bit and sort of why we asked that question in the first place. You'll recall I mentioned our previous events and how our goal was to sort of build over a series of events on topics and issue areas that really matter to people. In our last meeting in July on technology, we talked about the business case for energy storage with sort of a thought that if you are a hypothetical investor or a government official or something like that, what would you say, or how would you craft a case to invest in energy storage? And we went through that a lot. And the next step after you sort of create a good case is to figure out how to execute it. And finance is a key part of that. So what we wanted to do is talk a little bit about the financing life cycle and the different roles that people play and their perspectives on finance. What are things that they think about? What are things that concern them? What are they excited about, et cetera, et cetera. So with that in mind, we've put together the panel here, and I'll introduce our speakers in a minute, but you'll see there's a lot of MDB representation here, which that's who we work with, and those are the financing cycles that we understand. But we think that the panel brings a good diversity of perspective. Obviously, debt lenders are well represented, but when it comes to things like blended finance, there's some equity investor perspective as well. So we're going to start off by sort of asking the question that everyone asks: what makes a project bankable? What is bankability in the energy storage space? And to do that, I'm going to turn to Bassem Neme with IFC to really kind of set it up to say, what does IFC, which is the MDB that works most closely with the private sector, what do they need to see to make a project investable for them, make it viable in their mind? Then we can start to get to some of these regional differences. And you see that Bassem has experience in MENA, and he'll share that regional perspective with us a bit. We'll then go to Tristan Knowles from Asian Development Bank, where he's really been focused in the Southeast Asian market, and what are the conditions there and what sorts of things are needed to make projects investable there. After Tristan, we'll turn to Joan Carrillo, who works with blended finance in Latin America and Caribbean. And he'll share sort of a different view on how blended finance can play a role and ways it can sort of support projects in slightly different ways. And then we'll turn it to Vinayak Walimbi, who is taking more of an off-taker perspective, and he'll share with us sort of what the value of long-term modeling and forecasting is in trying to determine whether a project is bankable or not. So let's go ahead and get started. I'll turn it first to Bassem Nemi, who is an investment officer in the International Finance Corporation. Bassem, if you would like to quickly introduce yourself and then get going, we're looking forward to it.
Yeah, thank you, Danny, for having me at this panel. I hope you can hear me well. So I'm an investment officer in the Sub-Saharan Africa region. We look at investing in infrastructure projects across the region, providing both debt and equity projects. I'm pretty much focused on in the energy space, and I've also had the opportunity to look very closely recently at a battery storage opportunity. So I've been tasked with kind of giving a bit of a flavor of what IFC looks at from a lender's perspective when assessing a battery storage project. So let me first start with, so in many ways, energy storage projects are no different than a typical energy project finance transaction. So project finance is a risk allocation exercise, and financing only close when all of the risks have been cataloged and mitigated. Having said that, there are unique features that are associated with battery storage, stationary battery storage, with which investors and lender will have to become familiar with. So a big focus for financiers such as IFC is the technology risk associated with these batteries. So there are, in today's market, there are a variety of technologies, of battery technologies. However, the only, at least that's IFC's view, the only bankable, predominantly and bankable battery solution is the lithium-ion technology. So it has more than 25 years of experience, of track record, of commercial track record in consumer electronics and EV industry. Now, to our knowledge, no other technology has been debt funded to date. The third point I'd like to make is while batteries offer the greatest benefit when not linked to a specific generation asset, what we have seen, ironically, is that very often these batteries are coupled with renewable assets, whether it's solar, whether it's wind, or whether it's a combination of both, and to provide firm power with fixed capacity payments under a long-term offtake agreement, a long-term purchase agreement. So this was the case under the risk mitigation program in South Africa, where batteries were essentially sized to meet a dispatch window of 16.5 hours, starting at 5 a.m. in the morning, going all the way up to 9:30 p.m. in the evening. And so with the support of our industry specialists, so we really look very, very carefully at how the modeling is done to make sure that the sizing of the batteries is correct, because not only does it have an impact on the project revenues, so these projects are being required to provide firm power during this dispatch window. That means they need to be 100% available. Having a lower availability can translate in lower revenues. And if this becomes recurrent, there's a threshold at which it becomes a seller event of default, which would lead to termination, which of course, as a lender, we'd like to avoid as much as possible. Another important point, particularly for pure renewable hybrid projects, the challenge is meeting the reliability test at COD, and so at commissioning. So because these plants are they're required to provide that firm power, but it's also a function of the solar or the wind resource at the time the test is being done. So that means that the battery needs pretty much to be oversized to cover for these downside scenarios. If we can move to the next slide, please. So another critical area of focus is the battery degradation or its performance over its life. So batteries as such don't have a design life, they more have a cycling life. So the same battery can last 15 years or 5 years, depending on how it is operated. So if it's cycled only once a day, it can last up to 15, maybe even 20 years. But if it's cycled more than once a day, which means charge and discharge more than once a day, then we can see the life that could have a negative impact on the life tenor of the battery. Now, how do we mitigate for this risk? There are three options. The first option is we can oversize the battery from the onset, but that of course translates into a higher financing requirement from the onset, which can be a constraint. The second way of mitigating for battery degradation is to augment or to replace batteries throughout the life of the project. And that can be done through two means, either through setting up a maintenance reserve account that is funded with project cash flows through the life of the project, or by entering into a capacity maintenance agreement with the battery supplier, and that aims to keep the capacity of the battery or the constant. Now, the third element is the battery warranties, and these are critical. So these battery warranties are essential. Essentially, they promise the project to that a certain level of performance or a pre-agreed level of performance is met, but typically it also comes with a constraint. Particularly, there's a requirement of a certain usage. Particularly, as I mentioned, the cycling is very important, and the environment in which these batteries will work. So, in short, in relation to battery performance and battery degradation, we really need to understand, one, how these batteries are expected to operate in the project context. Two, what are the arrangements that the sponsors would put in place to mitigate for the degradation, and so that they're able to provide, for instance, a firm power if that's the ask. And the third, assess the battery warranty arrangements to ensure that they are satisfactory. That means also they are being provided by a creditworthy supplier, and they are solid. The warranties are solid and enforceable. Now, in terms of the financing, I think CIF, and the reason who's bringing us all together here, provides a very important tool, which is essentially the support of donors to scale up this technology in its early stages. Now, what I would like to say, at least that has been our experience recently in South Africa, is that concessional senior debt is excellent, / grants, great. I mean, of course, it helps reduce the tariff, so that's very attractive. But our experience, especially to get the lenders comfortable and to mitigate for the technology risk that I've just described, concessional subordinated debt is, I would say, of even further value. It gets the lenders comfortable. It helps the project company or the sponsors achieve more easily the cover ratio requirements, and it provides that cushion to make the project bankable. The other aspect of it, and this is particularly known in markets where local currency financing is available, and this is maybe an ask to Danny, is to try to see whether these support can be made in the form of local currency solutions, because providing these solutions with a hedging requirement just offsets really a significant chunk of the value that these instruments bring to the table. Now, to conclude, despite the increased, comfort we have around the battery technology, it still has a limited track record. The stationary battery has a limited track record in terms of operation. We're just above 10 years, I believe. And so having strong sponsors, strong EPC and O&M contractors, and equipment from reputed top-tier suppliers remain the gold standards. Thank you very much.
Great, thank you, Bassem, for that. It's always good when you're moderating a panel to be put on the spot, so I appreciate that. Local currency is one of many issues that we see popping up again and again. It's something that I think we will continue to find ways to work with, especially as these markets mature and the technologies become more viable and the financing becomes a little better understood. So great stuff. Really, I think kind of sets the stage well and provides not only an overall picture, but a picture within a specific region. Now we want to turn to Tristan with Asian Development Bank to give us the regional picture in Southeast Asia. Tristan has been with ADB for quite a while, and before that he was working out of Australia. Tristan, please introduce yourself and take it away.
Thank you, Danny, and hi everyone. Yeah, so I've been at ADB for 4 years now, working in private sector climate finance transactions, essentially. For the last 3 years in our infrastructure finance team here in the Mekong region. Prior to that, I was at an organization called the Clean Energy Finance Corporation, which is sort of Australia's green bank. And when I left the CFC, the Australian market was just at the starting point of deployment of energy storage. And so it's interesting to see kind of the differences in markets and stages of market development between a market like Australia versus the Mekong in particular. So maybe we'll launch into the presentation today. If we can go to the next slide. So I think because it's a mixed audience and I wasn't sure how much people would know about the region, I think just to sort of set some scene setting overview, basically across Southeast Asia, for the most part, variable renewable energy penetration remains low. There's an exception to that, which is obvious in the table and I'll get to in a moment. But the reason to point that out is just that the underlying drivers, the kind of grid technical drivers for energy storage, we're not quite there yet, maybe apart from certain parts of the grid in these markets, and I'll touch on that later. Now, the exception here, of course, as you can see in the table, is Vietnam, where now around 37% of Vietnam's capacity is from wind and solar, actually predominantly solar. So it's about 25 gigawatts of the 69 gigawatts of capacity. And that's all happened very quickly, basically in the last three or 4 years. So I think on the one side, it's a really promising story of how rapidly the transition can occur. On the other hand, it obviously brings with it integration challenges that are, I guess, accelerating the need for energy storage in a market like Vietnam. In a market like Thailand, that used to be sort of the regional leader in terms of installed renewable energy or variable renewable energy capacity, you get parts of the grid where energy storage is definitely required from a technical perspective. And then in other markets, really, we're still sort of below the levels of renewable energy penetration, where energy storage becomes a major sort of, or a more important grid management issue. However, of course, all these countries have NDC targets under the Paris Agreement. And so we would expect that these percentages of renewables should increase over time. Maybe if we can, next slide, please. So I guess connected to the previous point, and just to point out here that, and these 2 points have been touched on by speakers already. In Southeast Asia, in particular in the Mekong, where I focus, the revenue sources and the regulations for energy storage still remain quite nascent or even non-existent in some markets. So just to give you all a sense of the market structure here, typically in these markets, you've got a regulated single utility, or sometimes you've got sort of regional utilities and maybe 1 or 2 or 3 utilities that buy, but it's not a wholesale market or the kind of market where you see energy storage playing a bigger role, like in California or Australia. And I guess connected to that point, you don't see at the moment ancillary service markets in the region. And so those 2 big drivers of a lot of the battery projects to date, one has been, of course, contracts for capacity. Others have been ancillary service opportunities and also wholesale market arbitrage opportunities. So from a revenue perspective, you're not seeing those opportunities yet in Southeast Asia. So if we look at the next slide, that being said, there are opportunities emerging, and I'll go through quickly one example that we funded here in Thailand, which is a small sort of pilot scale project. It's Thailand's first wind plus battery energy storage project, located in southern Thailand, which is a sort of weaker area of the grid in Thailand. It's a 10 megawatt project, so it's only 4 turbines, and it has a 1.8 megawatt hour battery energy storage system integrated into the project. It has a long-term PPA with the Provincial Electricity Authority, so one of those regulated single buyers in Thailand. And the way it basically earns revenue, this is basically a combined project where there's no separate revenue line for the energy storage, but it helps avoid some curtailment and increase the incremental revenue. So the project basically earns a peak and off-peak price depending on when power is dispatched. And then for the first 10 years, the project also gets what's called an adder in Thailand, or a bit like a premium feed-in tariff of 3.5 baht, which is about 10 cents US. CTF, mobilized through ADB, a program we have at ADB focused on integrated renewable energy storage and renewables, supported the project with a senior concessional loan of 4.75 million alongside co-financing from ADB and a commercial bank here in Thailand called K-Bank. The ADB and the CTF loans were in Thai baht, and the CTF loan was in USD and then swapped. So I would echo Basem's comment that we also see a greater need for local currency solutions in our markets as well. As I mentioned, that the BESS here is really intended to store energy when the output from the wind turbine exceeds the allowable limit under the PPA, and then to dispatch that power or release that power when the project's output is below the PPA capacity. So it's sort of an avoided curtailment model here. On to the next slide, thanks. So some of the challenges and sort of mitigants for a project like this, as I mentioned, there was no specific revenue for the battery energy storage component. So it really was sort of an additional cost that had some increase in revenue, but it's really seen as a pilot project by the sponsor, BCPG, which is a large and reputable renewable energy developer here in Thailand. The CTF, so the way we kind of mitigated against that is that we have conservative debt sizing. And of course, the CTF helped to improve the viability of the project, improve the coverage ratios. And legally, unlike some of the examples Basem was giving, the PPA wouldn't be breached if the battery system fails. So it really is a sort of pilot. and the revenue would be marginally lower, but there wouldn't be kind of a default in the overall PPA. So we were comfortable with that risk. There was regulatory approval risk because it was the first time a sort of wind farm with a battery system had been synchronized. And so we required basically a condition precedent that approval had to be obtained before we dispersed the CTF funding. There was sort of integration or slash technology risk. And again, the mitigants for this and really for an overall quality project are that you have a strong sponsor, as Bassem also mentioned. We had project completion conditions, of course, and we have reputable suppliers, both for the equipment. It was Samsung and Furukawa for the battery, and experienced EPC providers. O&M risk, we have a third-party O&M agreement, and obviously we had a technical advisor review O&M arrangements. And then because it is an integrated project, of course, you have all the typical risks that a renewable energy project would face. And so you have your typical protections there, covenants and security and various advisor due diligence streams. On to the next slide, thank you. So in terms of opportunities in the region, as I said, it's still at sort of a nascent stage, but I think you'll see more projects in a market like Thailand under a hybrid scheme that was launched a few years ago, but the projects are still kind of boiling away in the background. So there was a sort of semi-firm renewable bid scheme launched a few years ago. I think you'll also see some sort of industrial or bespoke projects in certain areas where just the site conditions mean that solar with storage makes sense from an offtake perspective. There are, of course, a lot of Southeast Asian countries have a lot of islands or even like archipelagos like Philippines and Indonesia. So I think you'll see island or remote sort of grid opportunities where your economic comparison is against diesel. So, you can already get quite competitive even with high levels of sort of energy capacity. In terms of the most promising fundamentals, I think in the region, most market watchers here, and certainly my personal view is as well, that Vietnam is a very promising market for grid level storage, basically to support the integration of these high levels of solar and wind that are coming online or have already come online in the market. I think one interesting area, that you could see is that reverse auctions and that sort of method of procurement is still, relatively recent in Southeast Asia, and that might be a surprise to people in other parts of the world, but Malaysia has been running auctions. ADB helped Cambodia run a solar park auction that achieved a regional low tariff. Vietnam is looking at auctions in the future, but hasn't sort of run anything yet. So I think you'll see more auctions. And I think what would be interesting is to see what the clearing price would be for renewable energy plus storage for, given parameters for that storage. So, the price that was obtained under the solar park auction in Cambodia was 3.8 cents per kilowatt hour just for solar. Now, I provided a range there in the slide of 8.5 to 16 cents for PV plus storage, but that was just kind of one data point, and it's actually based on a levelized cost of storage, which is a little bit different. But just to say, of course, there is a premium to purely the cost of solar, because you're obviously adding on the cost of the battery system, and then you're usually oversizing the solar as well to store excess energy during the day and then dispatch it at night. So it depends on how much energy you want to or need to store, and I guess the power requirements of the system as well, in terms of a power shifting model. But it would be very interesting to see what the clearing price would end up being if you ran some auctions either for grid level batteries for power and a little bit of energy, or if you did sort of renewable energy plus energy storage, and see what you could get in terms of a price for that service. Down the track, or maybe worth mentioning, it's not listed here, but I think pumped hydro is an interesting technology in the region. You have obviously a lot of hydropower capacity. You have some sites that are also looking at floating solar on top of the hydro. So I think an interesting mix in this part of the world could end up being kind of pumped hydro with floating solar and integrating renewables that way using existing hydropower reservoirs as well. And then I guess in the long run, there's more talk of hydrogen, though, you know, I think most people that watch that sector acknowledge that it needs very low cost renewable energy. So I think that's kind of a little bit further down the track. And obviously there are transport and other, you know, cost requirements for hydrogen that need to be considered. So I think there's an industrial sort of supply chain that needs to grow around hydrogen. And others, of course, we're always looking to speak to, you know, sponsors looking at developing projects. And, you know, often the best ideas and the people at the cutting edge are usually on the equity and developer side, pushing the frontier of the market. And where we as a sort of more of a lender, you know, try to support those projects and follow once, you know, the pieces are in place and it's closer to sort of financing stage. So, you know, any other ideas that come up are obviously interesting as well. And I'm sure we'll see things down the track like vehicle to grid and other exciting opportunities in storage. So I might stop there. Hopefully that's given a bit of a flavor of things in Southeast Asia, and happy to take questions.
Tristan, thanks a lot. Great presentation. We'll have Q&A at the end, so don't worry. There'll be plenty coming in, and I've already seen a ton come through Slido as well as in the chat. But really interesting perspective. I mean, Southeast Asia, as you said, it's a bit of a nascent market, so maybe there's opportunity for learning and sort of taking what we're seeing in other regions and trying to apply it. And I think in the Q&A, we can maybe talk a little bit about the value of some of the measures that you suggested, which is like, you know, what you can achieve with local currency lending as opposed to USD lending. And also, you know, I think Bassem mentioned the value of sort of subordinated debt and what that can do. So it's a good segue to turn to Joan, who is going to come in and give us the perspective of a blended finance provider, who can maybe use sort of different trenches of finance to provide different uses, different risk-bearing finance to support the phases of a project. John, please take it away.
Thank you, Daniel. Thanks for having me today. Good morning from the Washington, D.C. area. I will start with a very brief introduction to IDB Invest and the IDB Group. Then I'll follow with a brief overview of what is the blended finance role at IDB Invest, and then I'll go in detail into our experience financing battery energy storage using concessional funds. IDB Invest is a member of the Inter-American Development Bank Group and is a multilateral development bank committed to promoting the economic development of its member countries in Latin America and the Caribbean, and doing so through the private sector. At our annual meeting held in March this year, the IDB Group leadership outlined the Vision 2025, which puts forward a roadmap to achieve recovery and sustainable growth in the region. We are focusing on 5 opportunities, including regional integration and strengthening value chain, support for small and medium-sized firms, promotion of a digital economy, gender and inclusion, and last but not least, climate action. In that context, designing innovative financing tools to leverage private sector investment and promote climate resilient development becomes central to delivering on our 2025 vision. IDB Invest is the partner of choice for channeling concessional resources to the private sector in the region. For $1 of blended finance, IDB Invest leverages between $9 and $10 towards SDG-aligned investments. IDB Invest manages more than $700 million of blended finance resources from 5 donors, including the climate investment funds, divided in 16 funds or programs under management. Next slide, please. Through blended finance, IDB Invest pilots, scales, and mobilizes private capital towards innovative business models and new technologies that accelerate sustainable and inclusive market growth. In the context of battery energy storage systems, we are at the piloting stage, providing blended finance resources to demonstrate the viability of an innovative financing template, a new technology, or a business model. Under a demand-based approach, we are working in piloting solutions for different applications for battery energy storage in front of the meter. They are ancillary services, transmission congestion relief, and load shifting. In July 2021, we closed our first financing of batteries as ancillary services provider, So this is the case that we are going to share with you today from the perspective of a blended finance practitioner. Can we move to the next slide, please? But first, and at the risk of stating the obvious, and even more in an event like this, let me first go back to the case for battery energy storage in Latin America and the Caribbean. As blended finance practitioners, managing a scarce concessional resources that will be deployed as temporary subsidies, we need to address the commercial sustainability in the medium term of the relevant technology or business model to ensure that we are accelerating a process that maximizes impact and minimizes the use of concessional resources in the successive iterations of the intervention. Therefore, we need to have a look at the deployment of battery energy storage in developed markets and the economies of scale that drive costs down to bring a sustainable business case. Then we need to have a look at how batteries are being deployed in our region, where with data from 2019, less than 100% of the global capacity was deployed. So from our perspective, providing blended financing solutions to accelerate the deployment of lithium-ion battery applications to provide ancillary services in Latin America and the Caribbean makes sense in 2021 and is a good use of scarce donor resources. Next slide, please. So let's jump into the projects. So we are talking here about two transactions where the blended finance intervention occurred on top of two existing financings of utility-scale solar PV plants already operational in El Salvador. Providencia Solar is a 140 megawatt peak solar PV plant developed by the French IPP Neoen and already operational since April 2017. Capella Solar is a 101 megawatt peak solar PV plant developed by the same sponsor and already operational since February 2020. Both projects were contracted under a US dollar denominated 20-year PPA with Salvadoran distribution companies and were financed under a long-term project finance structure. So let's move to the right side of this slide. What's the issue at hand? According to El Salvador's grid code, all electricity generators interconnected to the transmission grid have the obligation to contribute to the grid frequency regulation by providing energy reserves when needed. The grid code establishes that each energy generator must be able to provide plus minus 3% of their active power available for primary reserve regulation and plus 4% of the active power available for secondary reserve regulation. For both primary and secondary regulation, the reserve will only be requested during the hours that the plant is generating. Since renewable energy generators cannot provide this service to the grid by themselves, existing regulation reserves account for flexible conventional energy generators, hydro and thermal power plants, providing these ancillary services in excess of their own requirements to assist the needs of the renewable energy generators, and thus being compensated for that service. Therefore, the sponsor had to project the payment of this service into their business plan, adding a plus 40% O&M cost to their O&M budget to compensate the hydro and thermal generators providing this service via the system operator. The alternative approach is that each solar power plant builds their own battery energy storage to comply with the grid requirements, avoiding the need to ramp up and down hydro and thermal power to readjust frequencies on demand. If the system is properly designed, current payments to conventional energy generators will be reduced to almost zero, and in turn, the sponsors will need to add the battery O&M cost to its O&M budget for a minor plus 1% on top of the existing budget. From a systemic perspective, batteries enhance the integration of renewables in the system, are also more efficient to timely respond to variability in demand than hydro or thermal power plants, and displace CO2 emissions generated by ramping up and down thermal power generation. So the business case is simple. Would the savings generated by switching to the battery technology pay off for the battery O&M cost and the debt service of the battery financing? The answer was yes. So why senior lenders financing was not available for that business case? Next slide, please. So the answer to this question relates also to the presentation of our colleague from the IFC before. The answer to this question is key to structure our blended finance intervention, targeting as directly as possible the barriers preventing financing of batteries at scale by the private sector in emerging markets. In our specific case, senior lenders' concerns were formulated around different expressions of technology risk. What is the track record of the technology provider? What happens if the battery does not deliver the savings projected? What would be the value of the batteries as a collateral of the financing? So the financing solution was designed taking into consideration the existing lenders' concerns and putting a template for a standalone battery plus solar financing for ancillary services. Regarding the technology provider risk, the tenor of the battery loan has been defined to not to exceed the maturity date of the pre-existing financing or the guaranteed lifetime of the batteries, whatever occurs first. This way, the tenors went up to 15 years, matching the guaranteed period by the technology provider. Regarding the performance risk, a technology risk trigger event that triggers a battery loan principal deferral was defined. This event will occur when the actual cost of the battery system, including the actual payments for the primary and secondary reserve, the battery loan debt service, and the O&M cost for the battery exceed the expected cost defined by the projected payments for primary and secondary reserve included in the base case that was agreed at closing of the pre-existing debt. Since the battery loan debt service and the battery O&M cost are known variables, the trigger event depends on the actual payments to the grid operator and indirectly informs on the availability of the battery during the reference period. This way, the battery is not available. If the battery is not available during a certain period, the payments will increase and together with the non-cost of the battery will exceed the projections of payments. Therefore, the battery loan will behave as a pay-as-you-save financing, where repayment of principal is dependent on actual performance of the battery. In terms of residual value risk, although both existing lenders and the battery lender will share the same security, the intercreditor agreement defines that the existing lenders will have a first priority over the existing assets of the project, and the battery lender will have a second priority over those assets. With regards to the battery lender will have a first priority over the battery assets, and the existing lenders will have a second priority. This way, while assuming the residual value risk of the batteries, the battery lender has access to a set of solar assets already built and performing. So to wrap up, next slide, please, just to wrap up, we have presented a pilot blended finance structure to finance battery applications for ancillary services in emerging markets, targeting as directly as possible technology risks. By 1, extending the tenors toward the guaranteed period of the battery, 2, defining a principal deferral mechanism tied to the availability of the battery, and 3, assuming the exposure to the residual value of the battery. Thank you so much for your time and attention, and happy to answer any questions in the Q&A section.
Thanks, John. Really interesting case study and kind of shows when the case can be made and made well that battery storage is, not only beneficial but can support assets in a way that traditional power assets maybe can't at a lower cost. But it requires a lot of, as you said, sort of understanding the roles that the storage will play within the larger energy system and with the asset itself, and how that will pay off over time. And that requires good anticipation of what your asset will deliver over a period of years. So with that, I want to turn now to Vinayak to talk to us a little bit about how long-term modeling can help mitigate risks and sort of put investors at ease when it comes to energy storage and how they can help, how they can ensure that the asset will make back what it needs to. Vinayak, please take it away.
Thanks, Danny. I hope I'm audible. Okay, so we have some great presentations, and I'll try to take threads from that. First of all, just quick introduction. So, I'm Vinayak Walimbe. I work as a VP of Emerging Technologies and lead our Emerging Technologies consulting practice globally. If we can get to the next slide. Just a little bit about Customized Energy Solutions. We are a consulting and a services company headquartered in Philadelphia. We have operations across the globe. In India and Japan are the other markets other than the North America that we primarily worked on. We have worked with numerous storage technologies for almost 15 years now, right from pumped hydro, compressed air, lead acid batteries, lithium ion batteries, flow batteries, high temperature sodium batteries, you name it. Our differentiation is really we are a services company along with the consulting. So we do have over 11 gigawatts of assets under active management. Storage portfolio is fairly small, about 400 megawatts, but we have a few more contracted. As the industry grows, we expect that to grow that significantly in future. And that's that operational experience and how it relates to financing is what I want to talk about. If we can get to the next slide. So just quick background. I'll talk a little bit in the context of US, but we have looked at projects in other emerging markets as well, and can talk about that as we go. But generally speaking, the storage industry, when it started, most of these projects were government funded or some kind of R&D funded, and it really changed with the long-term utility contracts. And it started with a regulatory support. So California started with a mandate of 1.3 gigawatt of storage. And then there are other orders that were issued. And that mandate paved the way for long-term utility contracts. And earlier there were a few instances in Canada, but it's really California that's changed the game in terms of long-term contracting, which now has facilitated the financing. Another things that earlier presenters also alluded to, so Tristan talked about the co-located or hybrid projects with renewables. So that also, although it doesn't necessarily make it easy, but easier to finance projects as lenders are getting comfortable with renewables already. And technologies like lithium ion, now bankers are becoming familiar and hence comfortable. There are other aspects like investment tax credits. They help with for a co-located or hybrid projects when they are integrated with wind and solar. I just want to go back to the first presentation of the session that Bassam talked about. And he mentioned that the storage life can be 5 hours to 5 years or 15 years, depending on how it gets operated. And that's where the analytical software platforms help. And I just want to take up that thread and talk about what these platforms need to look at and how they would help in financing. So if we go to the next slide, so this is in the context of the platform that we have called Grid Boost. But essentially, many of these analytical platforms work in similar fashion. So what they try to do is they try to maximize the value of the asset. So essentially, the model or the algorithms optimize the net revenue. So why do we need to optimize storage assets? So there are specific constraints that storage has. So first of all, storage is an asset that acts as a generator as well as load. It is also limited in its energy, and that makes it difficult to operate. And those constraints one need to account for. So when we are optimizing for the life or the value of the asset, there are two types of constraints that we are looking at. One that come from the asset itself, which are storage specific storage specific parameters like power, energy, efficiency, as well as number of cycles or cycle life. And you can provide a constraint that how many cycles you want to do in a day or in a year. And that goes back to the capacity guarantee that manufacturers are ready to give. And the asset owner can get capacity guarantees for different cycle limits, and it costs them differently. So depending on application, one can optimize how many cycles you would want to do. The other set of constraints come from the market itself, and it's a little bit different from the regulated market versus the market where the wholesale market is fully developed. But in both sets of markets, there are different kind of constraints that are coming in. So the market related constraint is how the wholesale market rules and regulations are. Can we do ancillary services and energy at the same time? What are the constraints there? Are we limited by the capacity or any other constraints that market regulators put in? The other set of constraints come from renewable assets. If we are looking at hybrid or co-located assets, those set of constraints need to account for. The optimization algorithm takes all this thing together and finds out what's the best dispatch for this asset. So this grid boost platform that we have, what it essentially does, it forecasts what could be the wholesale market prices for tomorrow, and it also looks at forecasts of solar or wind if it is co-located or hybrid asset. And it comes up with bids and offer sets that one can bid into the wholesale markets. And based on the clearing on the day ahead market, one can further run this optimization to create bid sets for real-time markets as well. So it gets a little complicated. But if we look at the chart at the left bottom, it shows that there's a base case, which is how the operators would usually operate the asset. But using a sophisticated analytics or optimization, we get almost 25 to 30% increase in the revenue. One can also maximize the life. So one can provide cycle constraints, and within that one can maximize the revenue. It just compares it with the perfect foresight as if we know everything together. The bottom right shows the dispatch, and there are some interesting things. With the lack of time, I'll skip the details. It also gets a little complex. But this is a dispatch that we are showing for a 10 megawatt asset. But if you see, it's participating in regulation at more than 10 megawatt capacity. It's because of how California rules are set up, and those kind of constraints we can account for. So if we go to the next slide. So these optimization platforms add value in terms of maximizing the life or the revenue. It also requires the right business models. And earlier speakers have already talked a little bit about this, so I'll not spend too much time. But for grid connected storage projects, what's emerging is largely it's a third-party owned model than utility owned. And there are contracts like ESA, what's known as energy storage agreement, that are becoming prevalent. What is interesting is along with these contracts, there is also a merchant component to it. So there are a few instances where there is a fully tolling agreement, but you get this merchant component, and that's where these analytical platforms make it more valuable for the asset owner. If we go to the next slide, it's for behind the meter projects. Again, it's the portfolio of the project that is becoming more of a viable model where the financing is coming for the portfolio of a project. So we will, I'll skip this and we'll get to probably the last slide. If we go to the next slide. Yeah, so our earlier speakers talked about different risks, and these analytical platforms help in reducing some of this risk. So technology risk for lithium-ion batteries, lenders are pretty much comfortable. But what these analytical platforms do, they look at specific technologies, their limitations. So for example, certain thermal storage technologies, they have limitations on the ramp rates. So these analytical platforms can account for that to decide how the dispatch can be done, whether they can participate in something regulation. If yes, how they can do it. The operational risk or the that also is reduced because of the analytical platforms like that. Because lenders essentially look at things like that. What are the asset operators promising, and what is their history of operations, and can they deliver what they are promising? So these analytical platforms for storage assets, because of their energy limitations and specific technology characteristics, are going to be critical going forward, and it will help with the financing. So lenders as well as investors, they need to get comfortable along with storage technologies, these kind of software technologies. And there are interesting things happening in terms of what's AI-based solutions, or what's commonly known as IoT-based solutions. So it's interesting space. Looking forward to answering any questions if you have. Thanks.
Great, thank you, Vinayak. Excellent presentation. So I think, there's been a lot of things covered, and I guess I'll say one of the key messages that came through to me is about predictability, and that storage potentially can and often does sort of improve the predictability of renewable assets. But the operation of storage assets, as Bassam said, is not always predictable itself. And so you kind of need active management and really thoughtful approach to how the asset will be used, which Vinayak, you were just mentioning with respect to the modeling that you all do. Let me bring all the panelists back for some Q&A. We have probably about 10 or 15 minutes to do that. And I'll just say, Bassam messaged me, and unfortunately he has a family emergency, so he had to drop off. He will not be available for this session, but he brought up a lot of good points, and I think others did as well. And so we can kind of talk about those. One question I have is sort of on the issue of standalone assets versus co-location hybrid systems. And, it kind of it came clear to me, at least in many cases, and I think it'll vary regionally and by country to country, that there are a lot of benefits of co-locating storage assets as opposed to them being standalone. And so I'd like to get your take on that. I mean, if someone is looking to get, invest in a region, should they just be looking for renewable assets wherever they can find them and trying to co-locate as much as possible? How long do you all think it'll take for the risks of storage to come down enough that they can be more standalone investments? Or is that not necessarily something, is that maybe not even a useful frame to look at it? Would love to hear your thoughts, and maybe I'll start with Tristan.
Thanks, Danny. It's a complex one, because I think there are sort of technical and sort of regulatory drivers for which one is A, possible, and B, makes more sense. So, I mean, I don't want to throw you under a bus a bit, Vinayak, but I think, the technical modeling of those two things is quite different, and the system requirements that would say drive more of a power solution that could be a standalone battery versus maybe the need to kind of provide semi-firm renewables as an integrated solution. I think it's quite complex. I'm not sure if your modeling work and what you've seen of California and other markets can shed some insight on that. And then, yeah, actually be interested in your thoughts on that complex question.
Yeah, it's a quite interesting question. So first, let's just see why this co-located or hybrid is happening. So first of all, there is something like investment tax credits that are there. And those are often given because of environmental reasons, right? So you want something renewables. So standalone storage as its own, can we say it is a renewable asset? So that was really a philosophical question, and it's not really a generator per se. It's a storage system. So that's how the tax benefits were given for technologies which are enabling more renewables, and storage is certainly that. And that either physical or at least co-location sort of ensured that you are charging through renewables. So these ITCs were extended, at least in US, for storage technologies that are charging 75% of the or more of times through renewables. And that's how we really started. As a system, and Tristan, you rightly mentioned that, it's not really necessary. So, I mean, models, if we look at the system level models, they essentially show that standalone storage can enable more renewables into the grid because variety of reasons. You can decide to co-locate if there is a significant curtailment that you can avoid, or you can decide to hybridize, but it's not necessary from a system perspective. In fact, many distributed storage assets may help. So again, in the US particularly now, this tax credits, there is a talk, and which has gained significant traction in recent time, that to give standalone storage these tax credits, because they are essentially enabling more renewables into the system. So from system perspective, one can decide how, and there is no rigid reason that it has to be co-located or hybrid. I think it just made it easier from a regulator or policymakers perspective to make sure they're indeed charging through renewables, and they just didn't want storage being charged with the fossil and more fossils in the grid, and they're getting charged through that.
John, you want to jump in here to offer your views?
No, just what I wanted to mention is that at least in the context of Latin America and the Caribbean, where we still don't see like regulatory frameworks addressing, you know, the specific needs of energy storage and creating business models that are specific for standalone battery energy storage. So, and as a blended finance practitioners, as I was mentioning in my presentation, so it's we need to start by somewhere, and it's easier to start when you are co-located with a solar PV plant, that you have access to an asset that has a long-term contract that has some certainty in revenues, and that allows us this kind of trade of assuming more risk on the battery side, but having some exposure to an asset that is like more consolidated. So I think that as we are now in the region, if we take Chile outside of the picture, because they are already developing a regulatory framework for that, and some examples in Colombia. So we are in the realm of trying to work with co-location with solar or wind energy.
Great, thanks for that. You all are kind of anticipating my next question. I'm scrolling through Slido here and trying to, there's lots of questions. I'm trying to combine a few of them, and I see a couple of questions on policy frameworks and regulation. And so I guess my question to you, because I think you guys have already answered some of these questions, is as you look out across different countries, different regions, and they'll all have their own particular policy frameworks, do you sort of expect or hope for some kind of convergence on different policy frameworks to help support energy storage? I sort of think, you know, with the renewable space, reverse auctions work very well. Feed-in tariffs have shown a lot of success. Do you see something akin to that, or hope for something akin to that in the storage space? And maybe we'll go in reverse order. Johan, what are your thoughts?
No, we see a lot. We see a lot of opportunities. One of the opportunities that we are looking at is that in technology neutral tenders for capacity and energy. So the case for renewables plus batteries is becoming you know, a winning option. So there's an example. There's a tender in Guatemala next year, 2022, that is technology neutral, and we will see probably some combination of renewable plus storage participating in the market. So that's something that is remarkable. Also, there are some other some PPP approaches for transmission congestion relief that are coming online in Colombia, which are also attractive on that perspective. So there will be, you know, several models that will be being tested, and at the end of the day we will see which of them solidifies and creates, let's say, a precedent. And that's part of our role. So piloting, testing those models and helping them achieve scale and mobilize resources.
Thanks, John. Others, your thoughts?
Well, I mean, I think it's quite wide range. So there is hard to really spot a trend, but there are policymakers are figuring out a variety of different policies that will facilitate this this industry and the projects. But it's really wide spectrum, right, from transmission and distribution applications to something like ancillary services. And to get to that kind of policy framework is actually quite a task. But I'll mention maybe one which is an interesting one, and those kind of things we'll have to figure out. So state of Massachusetts has come up with something called clean peak certificates. So the general idea there is rather than just renewable energy certificates, there is a concept called clean peak. So the technologies like storage or any other renewables for that matter, if they are contributing to serving the peak load, so the load at its peak, because those are the hours where you have highest greenhouse gas emissions or carbon emissions. And if you can incentivize projects to reduce emissions at that time, that means if they can generate and show that renewables, at least storage technology charged through renewables and discharging it peak hours, so they get these clean peak certificates. So that's sort of a mechanism which can be there, like renewable energy certificates. And RECs have helped renewable industry quite a bit over the years. So those kind of mechanism can be explored further. So we have done quite a bit of work on that. And the market has just started in Massachusetts. We'll see how it goes.
Yeah, maybe just to add briefly, I think Alejandro, the first speaker, kind of summed it up. And there's also a comment from someone in the chat about, from Gavin, about basically the fact that the grid needs to be recalibrated. And I think that's what makes this so challenging, is that, you know, we have a grid that was built for kind of, you know, a small number, let's say, of centralized generators, and then you're transmitting it in a one-way direction to the demand center. And where now the whole paradigm is kind of completely shifting, right? You've got generation on rooftops, you've got, you know, storage that could be at the project level, could be at the grid level. You've got, you know, even aggregation of virtual power plants through rooftop capacity. And of course, you've got the change in the demand profile or the load profile that Alejandro also mentioned. So I'm quite sympathetic to the difficulties that regulators will be facing and off-takers are facing in how they design policies that are resilient through this change, because we're really at the start of this. And as a, you know, financier, or even, you know, as a project developer or an equity investor, you're taking a 10 to 20 year view. So how do all parties take that view through this change without locking into things that are maybe inflexible in the future. So I think it's a really tough challenge that all stakeholders need to be mindful of. So I think in the end, we'll probably see a mix of a variety of approaches taken.
Thanks, Tristan. That I think is a great note to end on. And I'll just sort of reiterate that we are, the world is demanding really massive change to happen on a short time scale, 10-year, 20-year time scales. And that's when these assets are being deployed and trying to anticipate their viability over that time. It's going to be really challenging, but the experiences that you all have, that you shared with us today, I think are really, really helpful in finding that pathway forward. And I just want to express huge appreciation for sharing your expertise and your experience, and for a great conversation. I think it's been really valuable. Let's turn it over to Tom, who I think is going to lead us into a quick break before the next session. Tom, take it away.
Great. Thanks, Danny, and thanks to all the panelists for that session. Why don't we go ahead and take a break, and it'll be a little bit under 15 minutes or so, but why don't we return here at 5 after the hour? And at that point, we'll start up with our second panel that will be focusing on private capital mobilization for energy storage and clean energy. And we'll be talking with folks with direct experience working around the globe to be able to share their lessons and insights. So we'll take a break here for a little bit and start up again at 10:05. All right, maybe we could go to the next slide. Alrighty, so our second panel today is focused on private capital mobilization for energy storage and clean energy. We'll be talking about lessons from experience and have a panel of people who've been working around the globe on the ground on energy storage and clean energy. And so this is an opportunity to hear from presenters about their experiences and some of the particular opportunities and potentially some challenges for private capital and energy storage investments. Before we go to the panel, we did want to do another poll. Maybe we could bring that up on the next slide. And so for this poll, what we'd like to ask people is, what's one word for you that describes the greatest barrier to private finance for energy storage? And we'll have this pop up as a word cloud. Melissa just chatted into the Zoom chat, the slido.com link and the meeting code 260111 for folks to be able to use Slido and respond to this poll. So why don't I just give folks a few minutes to go ahead and fill that out. All right, why don't I just give people a few more moments here. If you have some thoughts, go ahead and add those. All right, in terms of the greatest barriers I think we're seeing here, it looks like cost and financial risk are rising to the top, as well as some issues around kind of policy and market design seem to be in there as well. Give folks just a minute or a moment or so to add any final thoughts on this one. All righty, why don't we go to the next slide? Great. So at this point, what I'd like to do is turn it over to Mike Ward with Climate Investment Funds to introduce the panel and the panelists. But before I do that, I do want to remind folks, if you are on social media, please feel free to post about the meeting today and things that you're hearing. The hashtag for that is keeping the power on, financing energy storage solutions. And Melissa has pasted that into chat. So Mike, with that, I will go ahead and turn it over to you.
Thank you, Tom, and to everybody who's presented already, and of course to all of you as participants who've been chatting in questions. Been really great to see the kind of engagement and understanding of this area of work. So I thought what I'd do is just provide some brief introductory remarks before introducing our panel. But not long, because it is an exciting panel and a group of people with very many insights. So I think just right at the beginning of the webinar, in his introductory remarks, Hussein highlighted the broad consensus that the amount of finance needed to achieve the Paris Agreement far surpasses the 100 billion figure that's talked about so often, and yet itself has not been met. It's estimated that the investment in renewables, including energy storage, will need to increase to around 776 billion a year in this decade to get developing and developed countries on track to net zero emissions by 2050. Mobilizing this level of finance will require really strong collaboration between private finance and the development finance actors, some of whom have presented in the previous session. According to Bloomberg NEF, a record $500 billion, $500 billion, were invested in 2020 in sectors relevant to the energy transition, including renewable energy, the electrification of transport and energy storage. And this share, and that although the share of the 500 billion that was invested in developing countries, excluding China, was a mere 21 billion, leaving enormous potential, I think, for growth markets, particularly for private sector investors. From 2019 to 2020, the amount invested in green or sustainability bonds doubled to 700 billion US dollars. And it's estimated that they're likely to be trillions of dollars in the pockets of sustainability conscious savers in rich countries, but that this money is not flowing at scale to the emerging markets where this investment so desperately needed. So to mobilize this private capital for energy storage and clean energy in emerging markets will require new approaches, including new burden sharing arrangements between investors, MDBs, and national public banks. These approaches need to build a pipeline of projects while at the same time streamlining the kind of deal structuring, particularly the sort of operational processes that were discussed in the first panel. To explore in more detail how this is being done and could be done better, as I've said, got 4 amazing panelists with a wealth of experience related to private investment in the clean energy and energy storage sectors in emerging markets. I think what I'll do is I'll introduce all 4 of the panelists and then invite each of them to make brief interventions to set the scene. After that, I invite all of you to send through questions using the Slido function, to upvote any questions. It really helps if people just upvote them. We can pick up the ones that have a lot of interest up at the top of the list. And then we'll use those to stimulate some discussion and further insights from the panel. So our first panelist is Ayla Majid, who is the founder and CEO of Planative in Pakistan. Ayla is an advisory and governance expert, actively involved in energy sustainability, climate change, infrastructure, and competitive energy market areas. Through engagement with public and private governance structures, Ayla shapes policy and perspectives related to energy transition, social inclusion, and sustainable finance. Our second panelist, Sébastien Decaux, is the Chief Commercial Officer at Sunfunder, where he's leading work on the new Gigaton Empowerment Fund. Sebastian's previously managed multi-billion-dollar funds working in Africa, Asia, Eastern Europe, and the Middle East. Third panelist joined us, Mahua Acharya, who is the MD and CEO of Convergence Energy Services in India. Mahua is experienced in green finance, renewable energy, carbon markets. In fact, Mahua has led work globally on carbon markets, including work with the World Bank. And then our final panelist, Julian Bermejo, leads Infraco Africa's business development team in East and Southern Africa and has extensive experience in project development, construction, and operations within the renewable energy infrastructure and water sectors around the world. So I'm going to really invite the panelists to fill in any gaps that I've inevitably left in these brief introductions. And to share their initial insights to start the conversation. And with that, I'm going to hand over to Ayla. Welcome, and over to you.
Thank you, Mike. It's a pleasure to be here. A very interesting and exciting discussion, and very timely as well. As you have also said in your initial remarks, that the kind of capital that has been made available and spent, but the distribution is not very equitable across different markets, and particularly when we look at emerging markets as well as developing countries. So I will be talking a little bit about the challenges that emerging and developing countries have with regards to energy transition, and which also includes battery storage. And then what the players involved can do at their end, and also jointly, and what are the key enabling, say, ecosystem enablers that we need to create. Can we have the next slide, please? Yeah. if we just look at 2020's numbers, so there was about 510 billion spent just on decarbonizing, which is absolutely great. However, the share that comes to the emerging markets is very little. It is, of course, skewed towards wealthier countries. So I would say that lack of reasonably priced finance remains the biggest issue. And why I say reasonably priced finance, because of the fact that when it comes to developing countries, the risks sort of go high. And one of the earlier speakers also mentioned about various risks with regards to technology, project, etc., and many others. I would just like to add on top of that the perception risk of developing in emerging countries. So that is definitely a very big challenge. Then another area that kind of hinders the growth or acceleration towards clean energy is the existing unstable energy mix, which is often, say, locked in long-term PPAs. Of course, there's a huge need to renegotiate these agreements, but that requires, of course, political wills, all the stakeholders coming on board. And at the same time, one of the key resources, again, is finance. Another area that sort of slows down this acceleration is the management of the base load, whereas it is very clear that we need to head towards cleaner fuels, cleaner energy. However, overcoming this prevailing inertia also becomes a challenge. And that too from, of course, pushing the stakeholders who need to sort of up their comprehension, and at the same time getting out of the existing contracts that are there. And at times that sort of becomes a political challenge as well. Then something that I've mentioned right at the outset, and I think the earlier speakers have sort of alluded to that as well. So there is lack of appropriately priced finance, which actually makes some of the projects not bankable. So what we essentially need to do is find really a middle ground. Can I have the next slide, please? Yeah. So with regards to, so there are different players that are, of course, part of the equation at the country level, as well as the in the private sector, the banks, the financiers, the project developers, at the government level, the policymakers, the regulators, etc., the finance providers, those who do the accounting, reporting as well. Everyone has a role to play. So I would say that it is really a cross-sector stakeholder collaboration. Governments in the recent, say, outcome of what we have seen in COP26 as well, and also recently, governments have really upped their level of commitments towards decarbonization and implementation of renewable energy. If I just talk about Pakistan, the government has upped a target of going up to 60% renewable by 2030 from 30%. So that's almost 100% addition to the commitment. So this is all good, but that needs to be materialized into projects. Then with regards to having RE policy, electric vehicle policy, incentivizing energy efficiency, all of that needs to be there. There needs to be a strong push. Stakeholder awareness and commitment, that still requires a lot of advocacy. When it comes to reporting and disclosures and monitoring of projects, and this is, of course, all stakeholders require this. The investors also require this. There's a lot of push. One recent good development that has happened is the setting up of Sustainability Standards Board. Investment in green technology, of course, this will be done by all private sector as well as all the stakeholders who are part of the equation. There needs to be a large-scale ESG push. And what really needs at the end of the day is end-to-end planning, exiting out of the expensive, unsustainable projects, at the same time provide electricity, creating social and economic development, creating jobs, and sort of tying in policies of all the sectors. It is important to note that even today, about 700 million people in different parts of the world are still without electricity. Can we move on to the next slide? So whereas we understand that technology has become cheaper, there are lots of efforts that have gone into reducing carbon emissions. However, there are still, say, in the whole framework, a number of things that need to be done. They need to be done in developing or accelerating the energy transition in developing countries and emerging countries, with regards to creating the enabling infrastructure from the technology perspective, from the storage perspective, scaling out electric vehicles, etc., addressing the market regulation issues, in some cases, creating enabling policies, and also getting out of the unsustainable projects like also a coal phase out. And at the end of the day, in ensuring that the right kind of capital and right price capital is available. Last slide, please. Yeah, so that's my last slide. I would just like to reiterate that when it comes to emerging markets share in the battery storage, we see that there is still, the 2020 numbers show that the emerging markets have sort of seen a very small chunk of that in investment going towards battery storage installation. By 2030, we see still we see a much higher number, but it's still not, say, at par with the developed countries. Renewable energy can be scaled for sure. There are power regulations, even renewable energy policies adopted by more than 125 countries. But when we look at the biggest barriers are reducing or addressing the country risk profiles, as also making sure that the available finance is there. So when we talk about, say, the price of energy mix, fossil fuel projects existing in developing countries can be as high as 15 to 20 cents per kilowatt, and renewables can be as low as 3 to 4 cents. And when we add on battery storages, and one of the earlier speakers mentioned that in Thailand that the cost was probably around 10. Even if that cost comes down to, say, 6 cents or so, the right kind of finance which sort of comes towards developing countries, that will really be helping in scaling. So at the moment, the biggest challenge is that the transition is slow. What we need to do is channelize large pools of capital, and something that has been committed in the recent COP26 as well, more than 130 trillion. The stakeholders, whether public or private, really need to ensure that there's equitable distribution, and a significant portion of that goes towards emerging and developing countries. And that is the only way we can, say, address the global climate change agenda and move towards remaining under the 1.5 degree targets that we have, and moving towards the net zero commitments. So I cannot reiterate enough that unless or until in the whole framework these challenges are addressed, the transition would be difficult. It is very doable, but it needs to have the right kind of support. So with that, I'll be very happy to address any questions and happy to listen to other panelists as well. Thank you.
Ella, thank you very much for many insights. I think the kind of really useful overview of some of the transition challenges, many of which are obviously interrelated, such as the kind of perception of risk and then the cost of finance. And yet, despite those challenges, I think, as you note, there is this huge ambition across diverse stakeholders, both public and private. And then the kind of need to ensure a kind of just transition at a global level in a way that ensures that we have support for this transition as we move forward. So thank you for those insights. We'll definitely have lots of questions and we'll come back as part of the discussion. Sebastian, I'm going to hand over to you and look forward to the presentation. Thank you.
Thank you, Mike. Hello, everyone. So I'm Sebastian Duquet, the Chief Commercial Officer of Sunfunder. Maybe a few words about Sunfunder first. So we are, next slide, Melissa. We are a 10-year-old organization. And what we do is that we provide a direct loan to clean energy organization, active predominantly in distributed clean solar energy in Africa. We do that for 10 years now. We have invested around $160 million that have been lent to 60 of those energy providers, predominantly in sub-Saharan African countries. With our funding, those companies have enabled more than 8 million, actually close to 10 million today, of population that have been able to get access to energy for the first time. We are replacing genset, fossil oil genset with a clean energy one. And we do that from A to Z with an internal team. We are 40 for managing those 160 million, which is really a poor ratio for an asset manager. But we actually do originate ourselves the transaction we want to do. We do the credit risk, the ESG assessment, we monitor the transaction. So that's why it's quite a staff-intensive industry. We work with blended finance product. So that's the name in the fund industry for the public partnership, public-private partnership. So our fund basically have different category of losses that depend on the appetite of the investor to take in terms of risk. And you typically have a first loss that is usually taken by government or foundation that protect mezzanine investor, usually where you have development finance institution that themselves protect the most senior investor that are usually the private impact investor with whom we work. So you see here a couple of names related to the first 3 vehicles that we have closed and that are fully deployed now. As you could see, DFC, so the US Agency for Cooperation, is our biggest partner. They have been a strong supporter of our 2 previous funds, but we also work with a European development finance institution like OEB, FMO, Swedfund, Bio, and the like, and also with some foundation. We historically receive the support of the Rockefeller and IKEA Foundation, and we also have a couple of other foundation like Leonardo DiCaprio one that usually were taken the first loss in our fund. So with those blended finance vehicle, we enable the private investor to invest in a relatively safe way into a sector that presents some risk. We are active in sub-Saharan Africa, so that means that the country risks are pretty high. A typical private investor, a European one, will not invest in DRC or Republic de Centrafrique. Last year, we did a telco solarization program in Republic de Centrafrique that represented 25 million, that is to say 1/3 of the private investment done during that year in Centrafrique. And we could do that only thanks to the fact that in our fund, there are first loss that are taken by foundation and government and that are protected the other investor. Melissa, next slide. So in a nutshell, the sector where we are active, so we historically are active in the off-grid solar equipment, so that's a solar home system. 50% of our portfolio is in such organization. So you have a couple of names now. They are predominantly in Africa, Delight, PEG, for instance. We do as well mini grids. That's when you have a village scale distributed rural electrification. That's programs that are currently under development, for instance, in DRC, quite broadly. Relatively recently, the last 7 years, we moved to commercial and industrial solar equipment on telco solarization. Basically, for telco solarization, what we do is that we replace telecom tower portfolio that are usually equipped with fossil genset with solar equipment. We also finance 2 organizations in agri-solar equipment for water pumping and irrigation, sun culture and Inspiral Farm, and we are eager to do much more. So as you could see, we finance sector where solar equipment could replace genset with fossil, or simply enable families for a solar home system equipment or a village to get access to energy. The link with storage is that most of our loans are actually financing the capex of those the organization we finance, the company we finance, and for the capex of those energy provider, a huge part is actually the storage of the electricity. And that's where we do not finance per se directly battery, but at the end of the day, a lot of our financing is indirectly for battery, or that are part of the solar equipment that the company we finance are providing. Next slide, Melissa. So as you see, our first 3 funds are about to be deployed, and we are currently fundraising for our 4th one, named the Gigaton Empowerment Fund. It will be a 500 million fund that will deploy 1.3 billion of investment throughout the globe. So we are eager to move a bit outside Sub-Saharan Africa, where we are still predominantly present, but to also do some investment in Southeast Asia and Latin America. We will continue investing in the 5 sectors I mentioned before: solar home system equipment, mini grid, CNI, telco, and agri-solar, but do also a bit of innovation. We have already a couple of projects that we are eager to finance in e-mobility, for instance, in Africa, where we see a huge demand, and also battery storage, where definitely we see more and more venture companies that are created that need private debt, because then we do private debt and not private equity. And as said, where today we are involved at 100% almost in Sub-Saharan Africa, we see opportunity for us to go to Asia and Latin America, because the partner we are financing in Africa are market leader now, and they are expanding actually in Asia and Latin America, and we are eager to accompany the growth in those jurisdictions. Next slide, Melissa. So what is exactly a fund structure? And I think it could complement what Ayla just said. So you could see here that in our blended finance vehicle, we have a first loss that we call Catalyst Junior Share Capital. That is the first one, the first to absorb the loss, the credit loss, currency loss, if any, the country risk loss, if a country fall apart and we are not able to get repaid. Usually, this first loss is taken, as I was saying, by foundation and government. For our existing fund, we are in contact with 3 governments in Europe and with 3 foundations to get what we aim to have, which is a 75 million junior first loss that will cover the loss if they happen in our fund. And then the second tranche, we call it the senior tranche. It's for development finance institution. Actually, usually development finance institutions do not take really the first loss. It could be strange, but that's usually how it is structured. They're eager to invest in a relatively risky share, but not the most risky one. And by such, we want to enable, for the first time, the private sector to invest massively in our sector, because usually the private sector have not invested so much, with the fact that there will be 250 million of super senior tranche that will be dedicated to private institutional investors. So it's typically a blended finance fund, as we call it, and where you have different category of share with different category of protection. Where do we stand in the fundraising? The fundraising is doing pretty well. We make strong progress in it, and particularly, Melissa, next slide, as we have been selected by what is called the UN Net Zero Asset Owner Alliance. organization. The Net Zero Asset Owner Alliance, as you could see here, gather the main asset owner of the world, mostly European, but not only. You have a couple of Asian and American one, that commit to have net zero emission on their portfolio by 2050 for some of them, a bit earlier for the other. There's a couple that already commit for getting net zero emission of their portfolio by 2035. And they issue a tender, this alliance issue a tender this spring, and we have been selected alongside BlackRock and the Allianz, the insurance asset manager company, for our fund. So this shows that there's a strong demand from the private sector to invest in vehicles like ours that could enable them to reach that net zero asset owner emission. Because our fund, for instance, will offset around 20 million of tons of CO2 as we plan to equip more or less 20 more million of population with clean energy solar equipment, and that will save more or less 2 to 3 million of tons of CO2 per year. And the fund is a 15-year-old fund, so altogether it's close to 20 million of tons of CO2 that the fund will offset. And as such, Net Zero Asset Owner Alliance is looking for such a fund. Despite our track record and this selection at the Net Zero Asset Owner Alliance, I want to share with you some of the feedback we receive and some of the difficulty for fundraising for such a fund. Just to say that we are on the safe side here, because we still plan to do a first close on our fund by May, so we are doing pretty successfully nowadays in our fundraising, but don't believe this is easy to fundraise in our sector, despite our track, despite the blended finance structure, and despite the selection of this Net Zero Asset Owner Alliance. And why? Next slide, Melissa, please. First of all, our sector, I'm talking about the off-grid solar equipment sector in frontier and emerging market, is not known by mainstream private institutional investor. And an investor invests only in a sector they know. So if they don't know the sector, you have to share studies to explain the sector, the dynamics, and we don't have such kind of study to share. Secondly, a lot of private investors invest in stock markets that are liquid, where they could find rated investment that they could sell in the market. Our investments are done in private debt in non-liquid markets, so there's no liquidity attached to the investment in our product. Thirdly, even if our fund could be seen as large with $500 million, for a private institutional investor, for a large one, this is still a small fund. So on one angle, sometimes we receive the feedback, our fund is too big. Another angle, we receive it's too small. We could invest in the 1 billion fund and not below. Thirdly, as I was saying, for blended finance fund, everybody talk about blended finance and want to do blended finance, and you have thousands of conferences where you are asked to speak about blended finance. But actually, the difficulty for blended finance is to find the first loss shareholder, those that will catalyst the fund and invest in the junior tranche. And there's very few, because as I was saying, a lot of the development finance institutions are actually not eager to finance in the first loss, and some even decided lately not to invest anymore in fund and not to invest in blended finance fund. So we received a couple of feedback from development finance institutions that really love the fund, the concept and everything, but say, well, internally, we are not allowed to invest in fund. Whether this is this fund or another one, we are not allowed. That's why finding the proper suitable investor for the Catalyst Junior one and even for the senior DFI is not so easy, while private institutional investors need lobbying, advocacy, training to get a sense about the sector. Still, I think we will make it and do a first close in May next year for enabling us to finance. But I wanted to highlight those challenges, I would say, for fundraising. Even if everyone push for a public-private partnership, it's not so easy to make them.
Sebastian, thank you. And yeah, I think some really useful insights there, a really sort of, I think, graphic representation of what blended finance looks like, you know, the many different stakeholders that are involved. And then some really grounded examples of what sharing of risk looks like. And this notion of sequencing the risk. So who is it that comes in at particular risk profiles? At the moment, we're discussing mainly, obviously, private sector finance, but there are other roles and other stakeholders, including, for example, philanthropy and others that may be able to become part of the sequencing of risk. So thank you. I'm sure that it's an area that we'll come back to. And with that, I want to hand over to Mahua, who has many skills, including some deep insights, I think, into needs in India, where she is based, and the role that various sources can play in responding to the scale and urgency of the energy transition needed in a country like India. So Mahua, thanks so much for joining us, and over to you.
Sure, thank you. Thank you. I've been here. Can you all see me and hear me?
Perfectly.
Okay, great. Firstly, thanks for having me, and great to have these presentations. Before that, I had the, I came into this call a little bit earlier than this panel, so I had the privilege of seeing the previous panel for a little bit. I thought let me just put a little bit in context before we get into details about projects and so on. Where I sit right now, I'm managing a company for the government of India. And the Indian government now, and I guess India in general, sits at a very interesting point in as far as the energy transition is concerned. And why I say interesting is that for the last 10-something years, the focus in India has been to increase, a big part of the focus has been to increase renewables and renewables generation. And of course, there have been other targets, and there have been targets around energy efficiency and afforestation and so on. I won't touch on that right now, but a really big chunk of potential and future emission reductions was going to come from renewables. In the past few years, what has happened is that whereas the conversation used to be about how much more renewables you can put into the grid, in plenty of forums today, the conversation is around to what extent is the grid itself a limiting factor for adding more renewables. And so the conversation is changing, and I would say it has even changed in many, many quarters because there are several states in the country that are simply finding it either impossible or just finding it very difficult to absorb more renewables. Grids are getting unstable because of the informed quality or informed nature of renewable power. The effective landed price of renewables is higher than coal, so it presents a real and serious dilemma. On the other hand, scaling renewables, which is pretty much amount to scaling solar, has its limitations. It's not about efficiency, but its biggest limitations is land availability. So really, there are countries that are, there are plenty of issues underneath that, but the countries at an interesting point where unless you build up the grid and its technical capabilities and markets around that, it's going to be quite difficult to further add more renewables and get to the inflection point of decarbonization and whatever that inflection point may be. So there are a number of things going on in the country in many, many quarters. And I would say to a very large extent, India has reached a point where discussions around quote unquote more tertiary market conditions are becoming relevant. What is the scope for ancillary services? Can we have a discussion beyond generation? Can we have a more sophisticated discussion around demand side management? Can we have a discussion around reducing the cost of storage? Because it's becoming very clear that even as recently as the targets announced in Glasgow, I'm not even getting to the net zero targets and so on, which are far out there. Much harder targets are in fact the closer ones. I mean, that's a lot harder to achieve than a 2070 target. And a big portion of that target is linked to the ability to produce firm power or the use of batteries for storage. And when you get into that business, you start discussing and thinking about costs. And so the market is at an interesting point where there's a lot of developments, discussions, planning at very different, in different quarters. The other thing that I think it's worth putting out here, I guess to some extent the international community, is a discussion around value stacking. And why I say value stacking is, as far as batteries are concerned, at whatever price they land in the next few months or next 1 year, most likely will not be able to compete with at least what's on the grid, not even what's going to come on the grid. And so we have to find a way, of course, we have to find a way to make battery storage commercially viable. One option is to wait until costs themselves fall. Another option is to create so much demand that costs will fall. And perhaps there is even a third way, and that is to do a little bit of experimenting under the policy framework and the policy architecture. And for that, I mean, as far as batteries are concerned, we don't have a policy system in India and in plenty of other countries as well, where a single battery asset is able to be put to functional use for providing more than one value. So to put it more simply, if a battery were able to charge your car and you would gain some revenue from it, the same asset or the same factory of assets should and would be able to do a number of other things, including provide ramping support and provide network management services, even just being available on an on-demand basis for ramp up when needed. And when you have all of these services that can be provided to the grid, depending on how eagerly or how seriously the grid needed it, or in other words, what is the economic value to the grid, then the pricing of that battery asset suddenly becomes very viable. So we don't have a system like that. We don't have a system where a battery asset could be, just thinking out aloud, could be used as a rental asset, could be kept on an on-demand basis, be paid a certain option on a put basis that is to be called under certain circumstances. There are financial instruments out there, or there are commercial instruments out there in the finance world that perhaps can be applied here. And when one does that, suddenly you don't have to add in the cost of storage and the cost of solar and then deliver to the grid the combined cost of solar and battery, and very quickly find ourselves in a discussion around subsidies. So there is some level of regulatory work that could be done in as far as business models or commercial models for batteries are concerned. That's not happening yet, but it can perhaps be done. And in other conversations, it has occurred to me that maybe this is something, only people like the World Bank can do, because it needs a certain level of convening power and a certain level of technical neutrality. There's a small project that we have been working on at a very, very experimental research level at this point, just mostly trying to conceive these plans. But the country finds itself in this sort of situation where very quickly in the next few years, India will have to figure out a number of things simultaneously. So, and I'm not even going to comment on the level of financing that we'll need, because it kind of gets meaningless after a point without getting into detail. So I thought I'll just leave it like that as an overarching context, and just happy to take it as it comes.
Thank you, Mahua. And I think it really does set the scene around a couple of issues. This notion of value stacking, I think, is a really useful one. How do we value the different roles that energy storage will play, and how do we financialize that, and then how do you build that into various business models? I suppose is a key consideration that many people are grappling with. And then this notion, and Danny mentioned it as well in his introduction, kind of key role that a group like the Climate Investment Funds plays around the sort of programmatic or cross-sectoral approach that allows private sector, I suppose, to sidestep some of the really high coordination and transaction costs that are needed in order to put those policy framings in place. So just to raise that, I think, as an important issue, and maybe we can come back to it. I think with that, I'm going to hand over to Julian, who I think will provide a very focused kind of and localized perspective from the many different roles that he's played, but particularly now the role being played in Southern Africa, and maybe to use that to illustrate some of the points that are being made. So Julian, over to you.
Thank you, Mike. Hope you can hear me okay?
Yeah.
Yeah, it's a pleasure and appreciate the chance to speak and share some insights on the matter today. In the interest of time, appreciating that we are close to the wrapping up the workshop and to allow the Q&A session, we'll try to focus in maybe in the areas that have not been touched on so far. And in the interest, as you say, of maybe localizing our lessons so far learned in the sector and experiences so far. By way of a brief intro, Infraco Africa is a company that is headquartered in London with regional offices in Nairobi, where I'm based, and Casablanca, essentially looking after project development and financing across sub-Saharan Africa, primarily in the form of equity. We are part of the private infrastructure development group that is backed by several European governments, primarily the UK, Switzerland, and the Netherlands. And we are also supported by IFC, DFI, KfW, and other multilateral institutions. It's worth noting that our core business revolves around providing the risk capital and expertise needed to develop these projects through investments to scale up the businesses and pilot new solutions. We basically aim targets towards job creation, obviously beneficiary socioeconomic impact as well. So we are not only looking into the financial returns, and also we look into governance elements and early stage capital mobilization. That is the role we aim to play, even taking the extra mile risk, looking into frontier markets that are in the spectrum of lower income countries across Sub-Saharan Africa. We have to date invested close to $200 million within 15 years and mobilized an estimate of around $1.2 billion. So our mission is, so to say, to be a co-developer. Obviously, we don't have the pretension to denominate ourselves a developer. We leave the lead role to sponsors and originators, but we want to contribute in the co-development of the projects at early stages and providing essentially equity or capacity building capital and project development expertise. There are other sister companies that are specialized in other instruments, or Infraco Asia in the case of being focused in Southeast Asia plus India. But for example, Guaranco is specialized in local currency and credit solutions and securities and guarantees, and Emerging Africa Infrastructure Fund is specialized in debt within the group. We have also a technical assistance facility that look into mobilizing early stage feasibility or viability gap funding or the required capital to de-risk the early stage development phases of the projects. Our commitment essentially towards energy transition is articulated by two key criteria points that must be present in all our investments, darkly or indirectly. That is ESG and associated principles such as circular economy or waste management or energy efficiency. And of course, the most relevant one that is climate resilient principles in the form of low carbon emitting projects and its components. So these notwithstanding that we target to achieve a market return on our investment, appreciating that many of the projects that we are involved with because of the risk profile may not be a bit positive until a substantial lapse of time in terms of the triangle affordability and commerciality and impact balance that we look into all our investments. To set up the scene of the continent and to put things on the challenge that we have ahead in perspective very briefly, there are a few figures worth noting related to the future of energy in Africa and energy transition. This continent has to date 17% of the world's population and only 4% of global power supply currently invested here. And they are some of the highest growth rates in several countries in terms of population. So it's expected to more than double by to 2.3 billion by 2050. So currently, and we're struck by the number that Ayla gave in terms of globally 700 million people without access to electricity. Our estimate is only in Africa is 600 million, probably because also of the growth of the population and the pace of this population. So not having access to electricity and grid of infrastructure expansion is not viable nor a bankable solution. That is sustained by the fact that many remote areas are not making a financial business case for the grid to reach those areas. So in our case, the off-grid solutions and distributed access and distributed energy forms a substantial part of the discussion. Moreover, the demand is set to grow from 700 terawatt hours per year to 1600 terawatt hours per year within this time frame, what is a significant growth rate as well. So the key challenge is addressing the sustainability within the growth and a sustainable energy supply altogether. Reliable electricity supply would require an estimate of four-fold increase in investments to $120 billion up to 2014. So taking off the broader infrastructure would entail 170 billion per year. There are also a few worth noting points in this context, and particularly in Africa, based on the experience of early stage companies and businesses, that says that the 80% of infra projects fail prior to financial close. The available capital from the private sector struggle to spend also in accordance with the requirements, mandate, and risk profile. So these locations are particularly also challenging in this respect. Moreover, DFIs sometimes are turning their attention to early stage development, but are set up to support larger and utility scale projects. And lastly, export credits are often disregarded and also disaligned with our experience, and export subsidies correspondingly. So the facilitation of export credit agencies are accepted by many of type of corporate welfare, but not necessarily align also with our investment mandate or how to find what could generate supplementary debt in poorer economies to support industries in relatively well-developed economies. Compared to the majority of fossil fuel dependent industrial countries, the energy transition in Africa presents some distinct features. So while topical matters in developed geographies include green hydrogen, carbon capture, storage, ramp up of electric mobility, vehicles, and infrastructure, the debate in Africa rather revolves around two important challenges that are, in my view, modernization and expansion. Modernization is about harnessing the continent's endowment of renewable energy resources, although unequally distributed, and it also implies that moving away from the use of inefficient and hazardous forms of energy. On top of that, obviously, resource and labor productivity need to be improved. And that is an additional challenge that we also want to tackle across our projects. And expansion is about bringing to scale adapted technologies to meet the energy needs of this growing population, of which up to date only 30% have access to reliable electricity. So from those that have access, only 30% is estimated to be reliable, is where energy storage can play a pivotal role. So with that, happy to go to next slide, please. Well, we all know, and I think it's abundantly stated, the role that globally energy storage can play in the energy transition, notwithstanding obviously that we have several technologies, some of them often overlooked. For example, we still believe that molten salt within the thermal or CSP can still play a role. Maybe not so much in African context outside South Africa, but certainly it's continually improving, although obviously the costs are not declining at the same rate as batteries, but it's something that can still play a fundamental role in supplementing storage capacity to intermittency of renewables. Pump hydro, we believe that they still can play a role, not necessarily marginal. Obviously depends on many factors, similarly to conventional hydro. And the rest, on top of the let's say, the most innovative, for example, CO2 compressed that is currently being developed, or of course hydrogen, although we have still some reservations about bankability of hydrogen projects when it comes to producing electricity from green sources. They can certainly play a role in industrial use of the hydrogen or ammonia production or others. So we're still assessing hydrogen opportunities within this space as well. But obviously the hype and the drivers that are essentially motivated by the falling prices of batteries is with lithium ion and other forms of battery. And the declining costs are giving them a more and more predominant role. What we believe that technical factors of the energy storage can make them being a game changer, and it's something that probably one of the key challenges is off-takers and utilities. In the case of large scale or utility scale projects, is that these off-takers in some cases not necessarily appreciate all these technical features. Of course, the spinning reserves or the store capacity or contributing to grid stability is reasonably easy to grasp, or even the cost and demand control. But for example, voltage regulation or frequency control, etc., is something that where the grids are not sufficiently sophisticated in terms of harnessing these advantages. In terms of the offtake agreements, maybe some distinct elements of energy storage. When it comes to agreeing of interconnection or power purchase agreement, it comes with the fact of the twofold revenue stream. One is obviously the capacity payment. Without that, obviously this project, especially we are talking about grid type projects, without the capacity payment that is long-term viable, these projects are not bankable. So this has to be present, as well as the determination of variable cost in the form of utilization payment. Even there are some discussions around local currency. We are having a couple of projects where local currency can play a role in the form of power purchase agreements, and with the support of our sister company. Next one, please. I will just touch on probably the key areas that, to me, and based on the experience in the region, constitute probably the major challenges and risks. The first one is probably the electrification versus the decarbonization. We start, as opposed to other markets, from a very low base as a starting point, and sophisticated or non-existent power system control. So this is particularly relevant when integrating renewable energy, because the controls that are required in terms of planning, in terms of refurbishment of the grid, and providing more modern and interconnection systems, including the smart metering, etc., are not present. So this implies a significant investment alongside the gradual decommissioning if we are talking about energy transition. So this is why we believe there is a combined effort, including mini grids or off-grid systems, where also the off-takers or small holders can harness the benefits of the grids, and this technology can be tested prior to moving into the large-scale projects. Other challenges comes from the fact, from the regulatory uncertainty, and added to the fact that these are, from an institutional and operational standpoint, they are quite demanding in terms of understanding the business model. This has already been touched on from previous speakers, in terms of understanding how the model works, in terms of recognizing the role of the battery, the charging, the timing. So I'm not going to provide further details on that. And lastly, key market drivers or that will boost the sector, and particularly within this context, have to do with the fact that cost and performance improvements and grid modernization that I have already mentioned and global movement towards this transition, as well as maybe reconsidering the feed-in tariff or net metering adapted to this new setup, and national policies in terms of setting up the right framework are probably the key drivers. The challenges that we are seeing so far are threefold, related to the sector, related to that I have already mentioned in terms of the perception of the sector in terms of still high prices, and the need for the standardization and the regulatory policies that have to be in place. When it comes to overseas or to cross-boundary projects, enabling environment across regional power trade is also a significant challenge when it comes to power trade energy storage. And lastly, funding in terms of securing the sources and proving the bankability of the model. This is why we believe starting from a small scale and off-grid systems is crucial. And last slide, please. So when it comes to funding and financing, sorry, the previous one, sorry, just very briefly. We need to understand that there are what are the type of projects that we want to be in and the different risk profile in terms of large or small scale, or whether we want to still focus on off-grid and behind the meter, starting with or with other applications that are front of meter. Cost-reflective tariff is the long-term goal, although not yet there. And the key aspects that are the technical advantages is how to monetize these both utility scale and distributed energy projects features when it comes to understanding these advantages. It's important also to understand the pass-through covenants of the requirements from original equipment manufacturers, how to test this model, and that is already proven in some of the developed work, how to translate that into these emerging and frontier markets. And considerations around permitting and planning and capacity building that for us is crucial. So, for example, we've been also assessing opportunities to set up battery manufacturing facilities where the raw materials, cobalt, or other minerals, for example, Nigeria and DRC are examples where we are already present. The last slide is about some examples of our projects, but happy to skip that and move straight. These are in Malawi with a solar PV plus battery storage under construction. Some mini grid experiences being co-developed with PowerGen in Sierra Leone and RVSol in Kenya. And I'm already mentioning our involvement with e-mobility because we believe they also play a role, particularly with the testing of vehicle to grid or vehicle to elsewhere technologies at a larger scale in terms of the grid integration.
Mm-hmm.
So with that, happy to take questions and comments.
Thank you. Thank you so much for a very, I think, contextualized, really useful to see the location of this sort of thinking in a specific place and those examples, and some great detail. We will, of course, share the presentations, and I personally look forward to going through much of the detail in the slides. So thank you very, very much, and to the whole panel, a big thank you. We've got about 10 minutes left. So what I've done is just kind of try to synthesize out some of the questions that we're seeing coming up in the chat, and I'm going to just ask each one of you one question that I think picks up on some of those key points. If there's something you want to add to one of the other answers, please feel free to do so. But we'll just kind of take a couple of minutes each. I'm going to work in the same order. So Ayla, just a question to you. There's this kind of truism that the whole is greater than the sum of the parts, and when I look across all of these presentations, I see lots of moving parts, and I suppose the question is around how do we bring these different parts together in a way that allows them to do more together than they can individually, I suppose. Yeah, so how do we bring them together better?
Yes, so Mike, I would say that it's stakeholder collaboration. This is the time more than ever for it, and also cross-sector collaboration as well. And we know that in this entire energy transition equation, we all are together. And it's not just, say, stakeholders within a country, but stakeholders overall. So it has to be the international financial institutions supporting, say, playing their role across the globe, wealthy private capital providers looking at emerging and developing countries, then the technology providers also sort of lending sort of their hand where they can. So it is essentially about that. And of course, finding projects, digging a little bit more deeper into where the needs are. Finally, I would say that more advocacy and awareness is still needed, because moving out of inertia still requires a lot of sharing of this good message that we are talking about.
Mm-hmm. Super. Thanks, Anna. Sebastian, just to come back to you, and it was something that really struck me about your presentation, was this kind of the kind of sequencing that needs to happen between different finance sources, and how that sequencing can support a kind of jump-starting markets, I suppose, on the kind of beginning level, that are perceived to be too risky for private capital. Things like providing guarantees, supporting policy reforms was something that Mahua brought up. And I suppose the kind of technical assistance who can play that role. And then the kind of large sovereign wealth funds, pension funds, insurance funds, using their size maybe to kind of aggregate and capitalize some of the assets. So just your sense of how we might bring some of the different role players together, but in a kind of sequenced way.
That's actually the discussion we had all this morning with the management team of Santander. We hope with the Gigaton Fund, like with our previous vehicle, to be able to pioneer on scale at the same time, which is something a bit contradictory. But the fund is designed to be able to do 500K, 1 million tickets, which are pretty low for private debt, huh? But up to 30 million ticket size with an average of 10, so a very broad, different category of loan we could do, a very different category of organization we could finance. And that's typically what you could do with blended finance vehicle. Because of the first loss shares that you have, you could convince the other investor that may look for less risk, like a sovereign fund, a pension fund, an insurance company, that as you have a Catalyst Junior share that takes the first risk for pioneering with small ticket size in new market or new sector, that they will be protected by, if some losses happen, they will be protected by the Catalyst Junior shares. But that means as well that probably we should envisage, that's something we are considering, alongside the fund, to have a kind of technical assistance facility that will basically do training, advocacy at both the sectorial level, but also at the investee level, to help the investee to be investment readiness, so that they could fulfill the criteria that us and a couple of other impact investors have to finance them. And also that with such a technical assistance facility, some of the costs attached to the transaction cost that we will have as an investor to approach new nascent sector could be covered. Because one of the difficulty for us is basically to have the risk taken, but this we could have with the first loss share, to have organization to finance, and with a bit of support from advocacy, lobbying, training, this could work. But also that our cost, our internal transaction cost, the time we will spend with those very small, because for us a 1 million loan is very small at the end of the day, the time we'll spend with those small loans could be covered also by some support, some grants, because it's not profitable for us to do it. At the fund level, we'll charge 1.9% of management fee. So basically, if we do 1 million ticket size, it's 19K, and this doesn't cover the time on all the things we do. So that's why we are thinking of having alongside the fund, a technical assistance facility and support for doing that. But I would say, Mike, that typically a fund like the Gigaton Fund should be able to keep its pioneering angle and also its scaling angle.
Yeah. Sure, Sebastian. Well, good luck with all of that. We look forward to following it over the next little while. So certainly some great work going on there. I'm going to turn to Mahua and just pick up Mahua on I suppose some of the stuff linked to the technical assistance, and it's a question around what advances in finance technology. You mentioned policy quite solidly, and any other areas that would really help to unlock further private sector investment in developing countries at the kind of scale that we know is necessary. So what are some of the kind of almost landscape changes that need to happen to unlock private sector funding?
That's a huge question now, Mike.
Sorry. at the end of a very busy day. I know that you've had a big day in India on energy. So
it's a huge question. Well, let me put all, I mean, they're all, of course, they're all important, but let me just prioritize. Let me put them on some sort of waterfall. When a market is nascent, what is the private sector looking for? It's looking for signals. And the typical cycle of, I guess, most private companies is that they first look at the signal. The more adventurous and risk-taking take a bet on that signal, and they invest in R&D or invest in early deployment, depending on where the technology is. So that's step one. So therefore, signal is completely key. And I've seen many discussions with private companies, the private sector and the public sector say, oh, you know, chicken and egg, which one comes first? No, I don't think it works like that. The government is still at the wheel. And for new things like storage, the government is very much at the wheel because the government plays a very important part in shaping the contours of a market. So that's one. Signal matters, and signal is all important. Now, the thing is, what happens after a signal? After a signal, you can't go quiet. You have to follow up. So then you follow up with either with a trial plan, or you follow up with the trial period, or you follow up with a policy framework without penalties. So there is some framework that has to come. So that's the next piece. So when people say policy framework, often, I mean, of course, I know what that means, but I think sometimes it's important to be a little bit more granular. What are we really talking about? Is it a 2-year trial? Is it a 3-year trial? Is it a normal thing, a normal policy without the penalties? So there are ways to do it, and that has to come. And then after that, there has, I guess, from a policy point of view, it is sort of long-term freedom, that there is going to be a policy. We take this asset seriously. We understand that it's necessary. We put it into our policy framework. All renewable energy, for example, will have to be firm or whatever, either on the demand side or on the supply side. But a sufficiently solid signal that stays for a period of time. Because now you have the companies who are no longer the ones who put a bet on it, or the early movers. Now you need the masses, or you need the early movers to deploy serious amounts of capital. And for that, you need a bit of a runway. So this policy, I would just break up the policy framework thing into step 1, step 2, step 3. So I would say that's absolutely crucial. Money is not looking for more money. Money is looking for places to invest. And money's friends are looking for friends. I mean, it's the shortage of good opportunities, quote unquote good, is very serious. It's serious all over the world. I mean, I've now worked in a number of countries. It's a serious issue right through. So money is looking for decently structured, not deals, decently structured investment opportunities that perhaps start with the deal, but then you need the bit of the longevity. So that's, I think, if I were to just say, well, in that waterfall or in all those things that you presented, first and foremost is the policy architecture, because then money comes in.
Super. Well, thank you. I'm not sure how you keep that clarity after a day like today, but really appreciate the insights and a really useful kind of, as you say, just a kind of waterfall or cascade of what needs to be done. I'm going to give the last word to Julien, and maybe just a really brief comment, Julien, and I suppose inspired by some of the questions around, you know, what are some of the the most commercially viable energy storage technologies that you're seeing as you look around? And I suppose also inspired a little bit by the picture at the end of your presentation. You know, if where is it that the private sector is kind of focusing around energy storage, particularly at the moment?
Yeah. Well, in terms of particular technologies within the energy storage spectrum, it's clearly lithium-ion, or at least those that, because of the track record and because of the bankability proven so far in developed markets, and this is something we want to extrapolate within this emerging and frontier market, is probably the one that is most mature. That said, obviously, we have a technology risk element that has been already highlighted by some of the speakers. We don't know where the technology is evolving in terms of next steps with the new, electromechanical technologies and hydrogen-based that may change the scenario in a matter of just a few years' time. But so far, in terms of particularly less risk-averse funding, certainly is lithium-ion. We are, and unfortunately, or because of the role we want to play, we are seeking to fund projects where the developer or the sponsor is unable to raise funds elsewhere. So this is let's say the extra risk that we are keen to take. So this involves also the technology risk. So that's why we are also looking into other forms of energy storage. But because of the falling prices and because as well of the local content that has to be present in these locations, I have previously mentioned around possibilities for setting up battery manufacturing, but this also includes battery disposal or second life applications for batteries will play a key role in making these cost effective and sustainable in the long term. But certainly that I would say is probably the most proven technology so far in the energy storage area.
Thank you, and a big thank you to all of you for insights, I think, into the many different stakeholders, to the many different technologies, and the many different kind of processes that are needed to support private sector investment. So just with that, a big thank you to you, a thank you to everybody who sent in questions, and I'm going to hand it back over to Tom. So Ayla, Julian, Sebastian, Mahua, thanks, and cheerio.
Thank you.
Thank you.
Great. Thank you, Mike. And thank you, Ayla, Sebastian, Mahua, and Julian for that very interesting panel. And thanks to all of our panelists for today. We just have a few more minutes left in the event today. We wanted to take a quick moment just to get some feedback on today, and to the extent that people have participated in previous Global Energy Storage Program events this year, feedback on that as well. So we'll launch our final poll of the day before we go into some closing remarks, and would just like to get a sense from you all of, what are key insights that you've taken away from today or from any of the previous Global Energy Storage Program events that we've had over the course of the year. So that poll should be popping up for those of you who are on Slido, and we can add the Slido information back into the chat as well, or we're seeing it on the screen right now, the slido.com, and then 260111. Give people a few moments to address the question. I'll give folks just a few more moments to add in any thoughts or key insights from today or any previous events. Great. Give folks just a few more moments to get any thoughts in. It looks like a lot on context and kind of the key role of an enabling environment for investments, as well as some specific aspects of financing structure. All righty, great. Well, thank you, everybody. Thank you for participating today and sharing these insights. Why don't we, I'd like to turn it back over to Danny Morris with Climate Investment Funds for just some closing remarks from the event today.
Thanks, Tom. Thanks, everyone, for your participation today. Really great discussion, really rich content that will, hopefully support all of us as we move forward in, trying to get energy storage deployed across the globe to help support the energy transition. I was just sitting here thinking about some of the messages I heard, and there were a lot of common ones throughout our different presentations. Some of them were included in the Slido answers that some provided. I think, this necessity of subordinated or junior debt to kind of bear the load, bear the risk load to help move things along is one thing that came out. The centrality of policy and how closely it's interwoven with other aspects of deploying storage projects is really something that came through for me. And, it sort of brings me to a larger insight that I received, which is that storage can't happen in a vacuum. And that's a bit of an obvious thing to say, but it's really been brought home today in the way it's been illustrated that storage is so interwoven with so many different aspects of power systems and what services it can provide and how those services can or cannot be monetized to sort of lead to the kind of returns that investors need to see in order to get active. And it was brought out a few times that this sort of issues of storage really extend to issues of grids and how is the grid managed and how do we change power systems in both the developed and the developing world away from the traditional model of centralized assets that distribute over a network, and they are, they respond to peaks that happen at certain times, but supply is, relatively consistent based on the inputs of fuels that, are extracted and imported or brought in at a regular pace. Now we have a need for a more dynamic system and one that has more intermittent inputs and assets that can handle changes, that can respond to shifts in supply and shifts in demand. And it calls for really a rethinking of our energy systems overall. As with that, I'll sort of leave you with just a little conversation about what we in the climate investment funds are doing in response to that issue in particular. And you may have heard Hussam in his comments allude to the Renewable Energy Investment Program. That is a new program that CIF launched at COP26 about 6 weeks ago, where we are working to sort of tackle these grid issues overall and really help countries figure out how they can transform their energy systems to accommodate more renewables and help transform their energy systems to get on a zero carbon pathway. We have selected 5 countries for the first investment plans to be developed. Those are Ukraine, Colombia, Fiji, Kenya, and Mali, and have asked an additional 5 countries to begin preparing an investment plan to be supported with additional resources. We now have about 250 million to support those first 5 countries. And we will be continuing to fundraise over this year and the coming years to make sure that we can get full support for our phase 1 countries, those first 5 that I mentioned, and then others down the line. And this is really a frontier area where we're going to be working closely with countries, with our MDB partners, to figure out what renewable energy integration investment plan looks like, and what kinds of things will it be doing, and what kinds of financial tools and mechanisms are needed to support that. So look at this space for information and convenings moving forward. I think we're going to want to draw on this community for insight and for good ideas. I think really the next phase of the Global Energy Storage Program is figuring out how to support renewable energy investment or integration everywhere where we see assets deployed. So thank you all for your participation. We hope you'll continue to stay engaged with us. Look for announcements from us for future events and opportunities to come and bring this community of practice together to help inform all of us about where things are and where they're going with respect to energy storage and the clean energy transition overall. Once again, just thanks for your time, your participation, and we look forward to catching up with you in the future.